Hi, welcome to the Tape Reading Trader program. My name's Mark from TheDaytradingroom.com, and I want to talk a little bit about the course content, what you can expect from the program, a little bit about individual sections of the program, and how best to approach it to maximize your tape reading learning experience. So, first of all, I'm going to talk a little bit about what is tape reading. Where does it come from, the history of it, why it works, a very important question to ask, and the concept behind it. And then I'm going to talk about setting up your screens. Now, whether that's a single laptop screen with an extra monitor, or whether you've got a bank of 20, I'm going to run through the best way to set up your screens and configure your layout for optimum tape reading. So we're going to touch a little bit about positioning of the dome, the time and sales, and how we can access that information in our peripheral vision without being focused solely on one particular spot. Then I'm going to talk a little bit about what we're looking for. It's very important to understand exactly what we're looking for when reading the tape. Now, obviously, it depends on the tape pattern and the tape setup and the strategy that we're employing when we're reading the tape. But ultimately, we're looking for the same thing but just in a different format. So we'll talk a little bit about that. Then talking about trading setups to integrate with the tape. I couldn't do the Tape Reading Trader program without running through some basic yet very, very effective trading setups. So tape reading is most powerful when it's integrated within a setup. So I'm going to run through a few fundamental setups that are part of my trading strategy and perhaps integrate in with your own trading. Then move on to simple tape reading. This is the fundamentals, this is the basics. This is what you need to know before you can move on to progress to the more advanced stuff. So the simple flow of the tape, what we're looking for, how to combine the time and sales with the depth of market, what we're specifically looking for on each of those windows, what we're not looking for, how to get rid of noise, how to filter out noise, and just the basics to get us up to speed so we can get to a professional level and pick out some advanced tape reading techniques. Now, those are techniques that I use, they are patterns that I've spotted. Now, you're going to hopefully build on these. When you develop your tape reading skill, you're going to take those patterns, but you're going to create your own. You're going to spot your own patterns, you're going to develop your own strategies, and this course is designed around that. This program is designed around giving you the basics, giving you the knowledge that I've got, and then allowing you to take that knowledge and expand on it and building it for yourself to customize it to suit your personality as a trader, your risk tolerance, and your skill level. So the advanced tape reading techniques are techniques that I use every day and patterns that I've spotted and that I think are very useful. Then throughout the whole of the program, and especially towards the end, video examples. So for the simple tape patterns, loads of video examples. For the advanced tape patterns, video examples again. And then finally, an assorted video examples. Now, they are recordings from the market. They're recorded live, screen capture. You will see the tape as it happened during that trade. You will see, I will freeze frame it, I'll discuss it, I will rewind, I will highlight parts on the tape we want to look at, buyers, sellers, different aspects that are useful, different key pieces of information that are very important to the tape reading decision. So video examples, very powerful, very useful part of the program. I then talk a little bit about how to improve yourself in tape reading, improve your tape reading skills, and further learning, where to go. We never stop improving as traders. But as I said, hopefully this is going to give you a great foundation and you're going to improve on your tape reading and it's going to serve you well with your trading. Okay, so what is tape reading? Well, it's an old trading technique used by day traders to analyze the price and volume of a particular stock in order to execute profitable trades. Tape reading involves evaluating the size of stock orders, order speed, order price and order condition at ask, at bid, between ask and bid, to identify trends in trading behavior by insiders, professionals and the general public. These trends help a trader recognize good times to buy or sell. Now, if that sounded very robotic, it's because I read it from Investopedia. That is the exact quote. If you go to Investopedia, you will see under tape reading, that is the definition. And that's a pretty accurate definition by all accounts. Obviously, now we use it in the futures market. In fact, you can use it stocks, futures, FX, anything where you are getting a recording of the trades that have taken place and you have a dome, so i.e. a time and sales and a depth of market. If you've got those two things, you can tape read that market. Tape reading is it's an old technique. It does get its name from the ticker tape, as you can see for that gentleman there on the right hand side in the picture. That's a ticker tape there. The price would come through, and the tape reading would involve seeing the speed of the tape, seeing the size of the orders on the tape, pretty much similar to what we do now. The trades would come across there, and he would get a feel for the pace, the strength, the weakness, and the volume of the market. So today, it's not that actually that much different. As professional traders, we're trying to get a feel for the market. It's all about trading feel. Um, there's only so much you can do in terms of drawing lines on your chart and looking at chart patterns or fundamentals. As short-term traders, we need to develop that feel, and that's what tape reading is about. We start to see patterns repeat themselves. We start to get a feel for the emotion in the market. The marketplace is a group of people transacting, and the tape is showing their emotion. It's showing, it's almost a thermometer based on what's happening in the market. So we're looking for subtle clues that are going to help us make trading decisions. Now, obviously, the delivery method has changed. We don't get a little ticker tape machine in the corner of the office anymore. We've got so much more information to process. We can get whatever information we want on most of our trading platforms. But the fundamentals remain the same. We're reading what is happening right now. That's what tape reading is about. That's the power of it. And it's a technique that every professional day trader or scalper uses. It's a technique that does take time to master and perfect. And it's a bit of a combination of science and art, if you like. It's collating and interpreting information that's displayed to everybody, but it's all about interpreting it in a way to gain yourself an edge. So, why does tape reading work? Now, I think this question is overlooked by so many traders and so many aspects of trading. Too few traders question why something works, in particular trading setups and trading strategies and methodologies. You know, why does a certain trading setup work? What's the theory behind it? What are the people's emotions that's fueling that setup, that's making those people want to buy after you've bought in the case of a long, or want to sell after you've sold in the case of a short? What is the fundamental theory behind the concept, if you like, of the setup? Why does it work? Why doesn't it? And that's very similar with tape reading. What's the concept behind it? Why does it work? Why does reading the time and sales and the depth of market together work? So the reason that it works is that it is a display of what is happening right now. And it's best, if I use an example, just think, okay, you're a big buyer. Um, Lifting offers to fill your order or stacking the bid with a decent size. Either way, you can't hide the fact that you're making a buy. You're buying, you cannot hide that fact. You either have to lift offers, or you have to put the required size of your order. You may break it into chunks, and we'll see some techniques that institutions use for that later in the program. But either way, you need to do the actual buying, the actual process of buying. So to accumulate your position, you're going to have to use either markets or limits. Now, either way, you're leaving tracks, either on the dome and the time and sales, or on both. Of course, you're going to be trying to hide your tracks. After all, you don't want other market participants knowing your hand, but you can't hide your executions. Okay, you can hide your limit orders if you're using a market order, but that's going to show on the time and sales. And if you're trying to break it up into small limits, we're going to see that. And that's our job. As tape readers, we are trying to pick out generally large orders. We're interested in several things, actually. One of them is which side is more aggressive. Now, there's a little bit of a myth that the market is going down because there are more sellers than buyers, and vice versa. We hear that quite often in the financial press, and that's not correct at all. It's usually spouted by people on TV, but it's not true, because for every buyer or seller, for every buyer, there has to be a seller. For every seller, there has to be a buyer. For a transaction to take place, you need two parties. You need someone to take the other side of that transaction. So the real reason the market goes down is that sellers are more aggressive than buyers. They are hitting those bids. They are hitting the next bid lower. They're hitting the next bid lower. And that, the last traded price, is what's causing the market to go down, or the other way around, causing the market to go higher. So it's the more aggressive side causes the market to move. So we are trying generally to spot the aggressor, but that's only part of the puzzle. Because really anyone can look at a chart and see it going down and claim that sellers are more aggressive, right? But just think very quickly what happens when the market approaches a key support level, or it pulls back after a strong trend higher. How do we know just from looking at a chart if or when the supply demand balance will shift again? That's where tape reading comes in. We're looking at the actual price action. What's happening on the dome? What are people? Where are people putting their limit orders? What are the size of those limit orders? What is happening on the time and sales? What are the trades going through? The speed, etc. We're going to talk more on that later. But that's what we are looking for: digging into the raw action at key points, deciphering the tape variables. Now, traditional market textbooks are going to tell you that picking tops and bottoms at turning points is dangerous. And yes, if you're just looking at your chart and you're trying to pick a top or bottom, you're just stabbing in the dark. You're just picking a point. The market might be falling through the floor and appearing to smash through lows, through solid support on a chart, but the tape may well be telling a different story, the real story. This is a perfect example. You've got a chart here. It's a textbook triangle, right? Downtrend, you've drawn your line in on your downtrend, you've drawn your support there, and the textbook would say it's a triangle or a wedge pattern, and the next move is a break through lows, right? Not this time. You see, if you're not tape reading, you're not going to be able to see that solid buyer. In this example that was sat on the bid, he was scooping up every single contract at $86.73 on the chart until after the fact. You see, that's the fundamental problem with just looking at charts to make short-term trading decisions. You don't see strength until green candles or bars have been put in. You don't, and vice versa for weakness. Whereas if you're tape reading, you see strength the very second that strength appears in the market. The very second there's an aggressive buyer, the very second there is support there that's holding, you see that on the tape. Now, compare what your entry would be like as a tape reader, spotting that strong buyer, compared to the chartist, the traditional chartist, who waits for strength and then buys when he's seen the strength. So what does it take to be a successful tape reader? Obviously, you need to know what you're looking for. You need to know what the tiny signals mean. You need to know your advanced tape reading techniques. You need to know your simple patterns in the tape. You need to put in the screen time. Practice, practice, practice. Now, it's extreme, but look at people at the very top of any endeavor, whether that be golf, professional golfer, professional football player, a surgeon. Anybody at the very top of their field has practiced and practiced. And it's the same thing with a trader. Replay the examples over and over. No two tape patterns are ever going to be the same, but you're going to notice similarities. You're going to notice, hey, that's the same pattern that I've seen before. It's very similar. That's the technique. That's the little tip I was given in the program. And putting that screen time, putting in those hours, are going to start to reveal more patterns to you, and you're going to see the patterns you've learned in the program, and ultimately, then you can start to integrate it with your own trading and keep on improving as a trader. Okay, so let's get started with some terminology. I'm going to zip through this pretty quickly, as I expect most of you are up to speed with terminology, but of course some things are my own little words for things, not probably the textbook definition, but always feel free to Google the definition if you like, but I'm going to run through what I talk about. So in the examples that I'll show you the live tape action that we've recorded. I'm going to talk about long and short. Now, obviously, long is buying for the market to go up, and short is selling for the market to go down, or should I say, to profit from the market going down. Close and cover. Closing a position just means literally taking the position off completely, no more exposure. Covering tends to relate to the short side. So if you're covering a short, then that means that you've closed your short position. Scale means to take off part of the position, scaling in, scaling out. Most of the time, I'll talk about scaling out. So if you've got a 5 lot on scaling, you may take off a couple of lots. Bid and offer, same as bid and ask. I sometimes use ask, sometimes use offer. It's the same thing. It just means the orders on the sell side, and bid is obviously orders that are sitting on the buy side waiting to be filled. They are buy orders, buy limits. Offers and asks are sell limits. Hitting the bid, hitting the offer. Hitting the bid refers to a seller coming and hitting those buy orders, often seen with green on the time and sales. If I may say that someone's hitting that bid, it means that the bid is being filled. There's a seller coming in, filling that buy limit, and vice versa for offer. Lots or contracts, I'll interchange between the two. It means exactly the same thing. One contract, it's the minimum amount you can trade on an exchange, and it just keeps it all universal, depending on what you're trading. So crude oil, orange juice, corn, S&P, it's all defined quantities so that it's easy for the exchange to understand what's going on and for people to know their exposure. So one lot is one contract. Prints or printing. Uh, Prints means what has come through the time and sales, are collectively known as the prints. And printing means, I may say, in the context of let's say the halves are printing on the S&P, so 73, let's say 1173 and a half. So the halves are printing, just means they are now coming through the time and sales. They are trading. That's the current price that's trading, and the prints are really the time and sales. So I may say, look at the prints that have gone through, and I will mean the price and the size and quantity it's gone through. And support and resistance. Won't go into it too much depth here. I suspect most of you understand it already. If not, then there are probably textbooks out there that go into it and pretty deeply. But support and resistance generally means a support is a line, if you like, underneath the market, or a level underneath the market, which has held the market previously. It's where buyers of interest, is where selling shut off, and it's where buyers have stepped in, and vice versa. On the upside, resistance is a level or a cluster of levels above the market, which buyers have shut off and sellers have stepped in, and the market has struggled to go through. So that's support and resistance. Okay, so let's move on to the depth of market, or the dome. I just want to run through again. I am assuming most people are up to speed with the dome and understand the basic concepts of what is being displayed on the dome. But if you don't, then I'm just going to run through it very quickly now. So we've got three types of depth of market, or dome for short. TradeStation calls it a matrix. Price ladder, another word for it. On the left hand side there we've got Ninja Trader, in the middle we've got the TradeStation Dome, and on the right we've got interactive brokers, all showing different markets at different times. Although actually I think the Ninja is showing the S&P, TradeStation looks like it's showing the S&P, and I think that's might be JP Morgan or something like that on the right hand side with interactive brokers. So pretty much all showing similar stuff. Some things are missing from some of them, but the raw data is the same. So under the price column, we've got the price column there on Ninja, we've got the price column there on TradeStation, we've got the price column there on interactive brokers. Now that is showing the price, self-explanatory really, and the price goes from high to low. So the further up the ladder you go, or up the dome towards the top, the price increases, and down the price decreases. And you'll have a bid and offer. On the left hand side you've got, look at the Ninja now, you've got the buy column, and that's showing you all the buy orders that are stacked up in the market, buy limit orders that are resting there waiting for sellers to approach them. And on the sell side, these are all the offers or the ask column, and that is all the sell limits waiting for buy orders to hit them. And on TradeStation, slightly different layout there. You've got the bid is in the blue and you've got the ask is in red, and it doesn't straddle the price, it's side by side, but that's my configuration. I'll talk a little bit more on that later. You've also got added with the TradeStation the volume bars, which actually show you, they coincide with the actual volume column there. Is a histogram representation showing you how many contracts are traded, have traded at that price. So you can see it's 1326 there on the S&P. We've had 3,805 contracts traded. So that's the most of that's the most contracts have traded at that price so far. And the high or low on TradeStation is marked with the green line and the colours changing. On the right hand side you've got a similar thing, histogram showing you the total number of contracts traded on Interactive Brokers there, and you've got the bid column and ask column straddling the price. So let's move on to adjusting your dome for optimum tape reading. Now, this isn't obviously compulsory, this is how I like to do it, how I like to adjust my depth of market. Currently using TradeStation, no allegiance to any provider, but it does the job for me and seems to have good unfiltered tick data coming through, which is essential for tape reading. Also have a backup connection, which I put a data feed into NinjaTrader as a backups, but let's just talk now how I adjust my depth of market on TradeStation. Now conventionally you've got the bid column, the price and the ask in that order, but I prefer to have the bid and the ask side by side. Just find it easier to read, I just find it easier to see what's going on, less work for my eyes and easier to spot the changes. Again, personal preference, it doesn't have to be that way, that's just the way I like to do it. So that's the depth of market. Let's move on to level 2, and very quickly the differences between the level 2 and the dome or the depth of market, basically displaying exactly the same data. There are some differences, and level 2 is generally for stocks, because as you can see here, we've got level 2 of Lloyd's Bank, or should I say Lloyd's TSB now, traded on the UK London Stock Exchange. On the right hand side there, think, I'm not entirely sure, but I think that's JP Morgan again. But basically you can see that at each price level, differences between level 2 and the dome is at each price level on the dome, you've got basically a summary of the total available at that level. Whereas on the level 2 you're showing each individual order. So as you can see there on Lloyd's, if I look at the bid at 521.5, got a total of 41,744 there, but that's made up of those buy orders there resting, got the 8,200 at the top, 11,200, etc, etc. So that combination gives you the total available, and on the dome that will just be displayed as 41,744, but level 2 shows you each individual order. Now obviously it's the same principle, you are showing the bids, the offers at different price levels, colours showing you the different price levels changing. You also get to see with the US level 2 and the Nasdaq and the New York Stock Exchange level 2 who the participant is, so if it's a market maker, if it's an ECN or whatever, that's also displayed on the level 2. So really the tape reading, you don't necessarily need to use a dome or a ladder, you can use level 2. The principles are entirely the same. We're just looking at the response to the market for certain actions, combining it with the time and sales. I successfully used to tape read. I wouldn't really call it tape read, it was more, the volume was much less, but when I was trading on the trading London Stock Exchange shares, it would be very similar. You'd be watching the response, the bid and the offer to the trades going through. No different. The principle is entirely the same, but just use a dome now because obviously futures are displayed using a priced ladder, and actually I find it a little bit easier because the pulse of the ladder moving up and down also gives you a little bit of an indication as to strength and possible direction. So let's move on to the next key important window uh, in tape reading. The first was the depth of market. The second is the time and sales. These are our two main focus point windows. So this is TradeStation again. Two time and sales. We've got the S&P 500 E-mini there on the left, and we have crude oil on the right. ES is the code for S&P 500 E-mini, and crude oil is at CL. Now, what does the time and sales show us? It shows the trades completed. They are basically telling us what has happened. What has happened, what has just gone through, the trades that have transacted where a buyer and seller have met. That is what is displayed. It's telling us the time that trade took place. It's telling us the price that trade took place, excuse me, and it's telling us the quantity that was traded for that particular trade. Now these are color coded. Green means that the buyer was more aggressive. Now, I'm going to discuss this in a little bit more depth in the next few minutes, but for now, let's just think that the green means that the buy side came to this resting sell order. So they display that as green, meaning that the price transacted on the offer. And red means that the price transacted on the bid. A seller came to a resting buy order. That's what that means. Um, Positive and minus signs on TradeStation. The plus and minus just means the price has ticked up. So we can see there on the S&P 500 a lot of trade at 13.27 and a half. We ticked up to 13.27 and 3/4, and that came in with a little plus sign. Ticked back down to 13.27 and a half, and then there's a little minus sign there. And we can customize our time and sales very very nicely actually on TradeStation and on other platforms as well, and we'll just run through what we can do with that and how we can also display filtered and non-filtered trades. So the first thing I do when I open a time and sales window is trim the data. Let's get rid of things we already know. So the default on most platforms and providers and charting packages is to just show you everything that they can show you. So you've got the date there, the time, the condition, exchange type, price, size. Listen, get rid of it all. We don't need it. We just save screen space. We don't want to be distracted with useless stuff. And also color code it. You can color code it. Most are green and red, but color code it as you see fit. Just make sure that you've got two contrasting colors and you know what they mean. Some people use blue. I prefer to use green, whatever you prefer to do. Okay, so let's trim the data, get rid of things I already know. So get rid of the date. We know what, if we're day trading, we know what the date is, and it doesn't matter. Condition, we know what the condition is. The color is telling us that. We don't need to be told it's at the bid or at the ask. Exchange, if we're trading futures, we know what exchange it's on. It's different for stocks. But if we're trading futures, obviously we know crude oil, NYMEX, so we don't need to be told it's NYMEX. And type as well, trade, we know it's a trade because we've already configured that in the settings. So we trim it down, all we've got is time, price and quantity. And we can go even further if we're looking at a very, very active market and we're not necessarily too caught up on time, which is looking at the speed and the flow, we can cut off that completely, and so we've just got price and size. Those are the two important things, quantity and price. We want to know the price that the transaction took place, we want to know the quantity that was at that price, and the color coding is going to tell us whether it was at the offer or at the bid. Final thing we do with the time and sales is we're going to use filtering. Now most providers allow you to do this. Basically, we have unfiltered and filtered. Now, filtering allows us to show those trades that took place that were of a size greater than our setting. Now, I've set this here as an example on the S&P just to show trades that are 10 or more lots. Now, what's the reasoning behind that? Now, the reasoning behind that is, now actually what I will tend to do is for the S&P I will use 100 lots as a filter. So for filtered trades, I only want to see trades that come through 100 lots or more. The YM I'll use 10, crude oil use 10. Other markets you decide yourself. what you consider a large trade or not a retail trade. And obviously, there are some retail traders out there who are trading 100 lots of the S&P quite comfortably, but generally we want to see the large size. So what we do is we show two time and sales windows. We have unfiltered and filtered. Now unfiltered is going to show every single trade, and that's important because we want to know what the retail traders are doing. What are the retail traders are doing, how they're trading it, whether they're being stopped out, what their frequency is of trade, what their urgency is. And the filtered is just showing us large players. So we can't say for certain obviously that it's institutions, but what we can say is that it's large players. And if we're seeing thousands, 2,000s, 5,000s coming through the S&P 500, we can be pretty sure that it's unlikely to be a retail trader there. So that's why we filter. We filter to give us a bit of a clearer picture of where the money flow is going, but we still don't want to get rid of the unfiltered, because that's giving us useful information, giving us an idea of what retail is up to. We'll go into more detail about that later. But filtering is very important to do on your time and sales. So one thing I want to mention lastly on the time and sales is the colouring trap. Okay, now this is very important not to fall into this trap. Now I still see people fall into this trap daily. What does red and green really mean? What are the common misconceptions? Now a lot of people are going to say things like it's red and it's a sell, it's buy, it's green, it's a buy. It's not true. You know, for each buyer there must be a seller. You have to have a price agreement for a trade to take place. Now, the way that the providers and the platform providers and TradeStation and Ninja, etc., display this is they need to display it for you in a manner that makes sense. So, what they do is when there's a trade conducted at the offer, they'll put it down as a buy in inverted commas, if you like, but really all it is showing you that the buyer is the aggressor. The seller has been passive, he's left his limit there, but the buyer has approached him and taken that limit, and so they've displayed that as a green trade, and vice versa for red. Now, it's very important not to fall into the trap to think in your mind that green means buy, red means sell. It doesn't mean that. It just means that one side is more aggressive than the other. It just means a transaction has taken place at the offer or at the bid. And that's very, very important information, but we mustn't overvalue that information. We need to put it into the context of what's happening on the dome, what's happening on the depth of market. It's all very well there being lots of buys at the offer going through, lots of green coming through on the tape, but if the market isn't moving, it doesn't really mean a lot. So again, go into a lot more depth on that with some specific tape patterns, but I just really want to mention that don't fall into the trap of thinking greens buy, red sell, because it's not the case. A trade has occurred. The buyer is more aggressive when it's green, the seller is more aggressive when it's red. Okay, so what am I actually looking at when I'm watching the tape? Where are my eyes focused, and how do I have the windows arranged? Um, let's freeze things for a second here and bring out the marker pen. As you can see, I've got the bid column here and the ask column here. The price column is here. This is slightly different from the normal default setting for most depth of markets. They normally will have the bid, the price in the middle, and the ask on the right hand side. The reason I have it this way is so that I can see the most relevant information within the smallest screen space possible. On the right hand side here we've got the volume bars, which are telling me how much volume is traded at this level. A nice visual representation here. The TradeStation does a good job of that. And here's the actual volume figure. So you can see the cluster of volume occurring around the sort of midpoint of the day and the VWAP. But this is the S&P as an example. And I just want to show how my eyes move across the screen, the actual physical action of tape reading, not necessarily the skills. So my eyes are focused on here for the majority of the time. Most of the time it's this area here, because you can get so much information from just that little bit of area. without diverting your gaze too much. Of course, we can only look at one point on the screen, but we can see other things in our peripheral vision. So I will be looking at this point here. Here I can see the bid, the quantity on the bid, and I can also see the offer and the quantity on the offer. I can also see, when I'm gazing at these two prices, the sort of levels below and above. Now, that's not so important when we're trading the S&P. It's more important for faster moving stuff like oil or the YM, where the book is a little bit thinner and each tick is a little bit more of a little bit less of a move, should I say, than the S&P. That becomes more critical. So let me turn the screen pen off again, and we'll restart again. Okay, so we can see most domes will show you what the last traded price was. So here we've got a sell, two contracts at 13.28 and a half, and that's shown up there on the time and sales at the top, and that's the time. For me, that's London time. So what I will be looking at is these 2 points here. While I'm looking at that, I can also see the trades that are going through. More importantly, in my peripheral vision, I can see the color of this tape and the speed of this tape. I don't need to avert my gaze onto this time and sales. I can see the speed of it in my peripheral vision. We're very good at picking up speed in the peripheral vision. That's what the peripheral vision is designed for. It's designed to pick up movement. So in the top window here, I've got my time and sales, which is unfiltered, which is showing every single contract going through. And the bottom window, in this case for the S&P, I've got it filtered to show me every trade that is above 10 contracts. So 10 contracts or more in the bottom window here. So I can judge just by looking at this area here. This is my focal point, but I can also see my peripheral vision, these two key bits of information. Now you can lay this out however you wish. You may want to have your time and sales here, and another around this side. It's entirely up to you. So when the market is moving quickly, I can see the bids and the offers coming on, which is most important to me. I want to see who's coming on the bid. I want to see the quantity coming on the bid or the offer. I want to see the speed that it's filled, if he steps up, if he pulls it. I can see that information based on looking at both these windows as necessary. I may avert my gaze over to the time and sales just to be sure that I'm looking at the right thing, especially when it's moving very quickly and this changing so rapidly that you cannot register the actual price changes. I may be able to have to glance up and down, but I don't have to avert my gaze too far before I can come back to this very central focal point of tape reading. And then if I need to just reassess where we are in terms of the daily range, I probably won't be looking to execute a trade at that point, but if I need to, I can just quickly go over to my 3 minute here or my 1 minute here. Whichever time frames you wish to use. So my general window, it's all in this. This is my scalping, tape reading air zone, if you like, with my main focal point being here. Now, obviously, on my other screens, I've got different time frames, different markets, and that's when I'm sitting back and assessing the situation. But as it comes to tape reading, I'm looking at one thing only: this area here. So I'll leave the drawing tool off now, and we'll let the market move along. And we can see I'm watching the tape now. I can see it's slow. I don't need to be looking at the tape. It's not at a level that interests me. The market's slow, the volume's low. But let's look, for example, now if I was looking for an entry or I was looking for a potential trade. I can see good quantity on the bid there, the offer being taken. You see in the peripheral vision there's a reasonable amount gone through at the 13.29. Then I see it filled and a little bit more taken from the bid, but the bid not lifted. So I see the bid holding, and I can see all that without actually needing to look. Or even if I need to look, I can glance very quickly, and then I can be straight back on to the dome, which is the key point. I can see the normal market activity here. I can see the bid's light. It's less than 1,000, less than 500. I'm watching to see if there's any more buyers looking to get involved in this. Are they looking to take the offer here? Are they looking to join the bid? I can see all this just by looking here. I don't need to avert my gaze anywhere else, and that's an important thing when you're setting up your windows. You want to be able to have a main focal point and then have other useful bits of information just off your gaze so that you're not scanning around all your screens if you have many screens, or you're not having to close and open windows. You've got all the information there, so you know that a trade's potentially coming up. You know that a level of interest is coming up. So then you can purely tape read. You can see the action. You can see the pace of the market on the time and sales. You can see the quantity. This will give. If this starts moving quickly, you can know that there's good quantity coming through. You see the color to dictate who's the more aggressive side, and then you can see what's going on in the bid and the offers, and also you can see a few stages away from the best bid and best offer. So you can see if there's anyone putting orders, perhaps that might then go to 962, and then you might see that go to 1500. So you know that someone's moved 1,000 from there, stepped it up to the best bid. Again, more useful information to make your judgment from. Okay, finally, one word of warning. Reading the tape when the market's chopping around doing nothing will drive you crazy. It's a very, very intensive skill and it requires 100% focus. You know, you're looking at the bid, the offer, the bids and the offers changing. You're looking at the last price, you're looking at the time and sales unfiltered, time and sales filtered, the speed, the size of the orders. You've got so much information that your brain is processing. It'll drive you crazy if you're trying to tape read when the market's chopping around and doing nothing. And also, you know, unless there's volume flowing with a reasonable speed, the edge becomes less. You know, the perfect environment for a good tape read is strong move with good volume. Now, I'm not saying you can't tape read when the market's slower and the volume's less, but you need to be aware that during lower volume periods, all it takes is for one bigger institution to decide to become extra aggressive, and then your tape read that you feel that the feel you've got for the market is negated immediately from that one large order. You know, that's another perfect reason, by the way, to control your risk. Whereas if the volume's flowing freely and heavily, then you've got less chance of one big player coming along and changing the tape picture quickly. And of course, if the sentiment does change when you're reading the tape, that's the advantage of reading the tape. You've got more chance to spot it before it turns the market itself when there's loads of volume rather than when there's little volume. So watch your volume, watch the choppiness of the market. You know, we try to read tape only at key levels, at levels that we've determined we potentially want to get involved in the market. Now that may be a price level or that may be a certain price pattern, depending on what setup we're trading. So we only want to watch tape when we're about or we're considering entering or exiting a trade. We don't want to watch tape and make a decision purely based on just what we're seeing in tape. We need to process that and put it in context of where the market is. You know, because the last thing you want to do is to be reading the tape all through a quiet period, scratching off a few ticks here and there, scalping, only to be completely burnt out and unable to focus when the big volume move comes perhaps later in the afternoon. So conserve your energy. Read tape when the market is offering opportunity. Now it's obviously different when you're learning. You just want to read tape in terms of improving your tape reading skills. Fine, but if you're in the you've gone into the day, you're ready to trade. Don't just be constantly reading tape. You know when to back off, know when to step back, know when to come back in and read your tape. You know, and also it's worth noting that you know, getting good tape read doesn't guarantee the trade's going to go your way. Nothing does. You know, nothing. There's no holy grail out there. You can be the best tape reader around it, but anything can happen. Anything can happen. Unexpected news can come out. A massive order can suddenly come in, and it's why it's so important to control your risk. So important to control your risk. You know, you can't eliminate risk. That's what trading's about. But it's so important to control your risk when trading. But obviously, it's going to give you an edge when you can see that order flow, when you can start to feel the short-term move of the market. You'll start to develop an intuition, and it'll come from your hours and days and years of processing all that information. You'll start to pick up little clues, and then you're going to start to notice how tape reading improves, you know, your own personal trading. So we now know how to configure our time and sales window, our depth of market window. We know where to look when we're reading the tape, and we know the terminology. We're all ready to go. Basically, we've got everything set up and we're looking at the market. What exactly are we looking for? We can see the time and sales flowing. We can see the depth of market moving up and down. Our charts are printing the bars. So Yeah, great. What are we actually looking for now? Okay, I'll split it up into seven things, but then the eighth is really a combination of the whole lot and how it all fits together. And the first thing we're looking at is the speed of the orders. Now, that is the time and sales window. We're focusing on the time and sales window right now. The speed of the orders is how quick does that time and sales window flow. The time and sales window will come through, trades will come through, and it will appear as if it's rolling, scrolling along. And we want to get an idea of how quick those orders are coming through on the time and sales window on both the unfiltered and the filtered. Now we also want to know the size of the orders. Are we having lots of small trades coming through on the unfiltered? Are we having lots of size coming through on the filtered? What's the size of the order that's coming through? Then we want to know the type of the order. Is it the offer? Is it the bid? In other words, is it green or is it red? Then we want to look over to the dome, the depth of market, looking at the bid and offer size. What size is sitting on that bid? What size is sitting at their offer? I generally am not concerned too much with orders too far away from the market. That depends on the market you're trading, but as a generalization, really I'm only looking for the best bid and best offer. Perhaps one extra level, but really the best bid and best offer. Now we move on to more interesting things. The response of the best bid and best offer to trades. Now, what do I mean by the response? Well, I mean, what happens to the best bid when sells come through? When large sells hit that bid, in other words, when sellers are more aggressive, and let's not forget for every buyer there is a seller, but when large sells hit the bid and you get that red print on the time of sales, what happens to that bid? Does the bid decrease? Does it lift completely? Does it even go up? These are the important things. It's the response, as always in trading, it's the response of the market to an action that gives us the information we need. So what is happening to the best bid? What's happening to the best offer as the market trades at those levels? Okay, and then the second thing coming on from that is a response to the price to large trades. So what happens to the price of large trades? If a large trade comes through the time and sales, and this is a completed trade by the way, if that comes through the time and sales, does the offer lift? Does the price move up? So if we've got large trades hitting that offer, does the price go up accordingly, or does it stay where it is? Okay, just touching on things at the moment, touching on further concepts, but just introducing the concept of response of each individual part of the tape, the time and sales, the depth of market to each other. So what's the response to the price when we see large trades coming through the time and sales? What's the response of the price when we see large orders coming on to the depth of market? In other words, a large order comes on the bid. What happens to the price? Does the price back away from that large bid, or does the price hit that large bid? Is he filled? That's information we want. That's key information. That is tape reading at its finest. We are looking, we see a big order come on. Does the market move away from him? That's information. Does someone take him immediately? That's useful information. And now we look at all this, how this all fits together and interacts. So we've got speed of the orders on the time and sales, both filtered and unfiltered. Size of the orders coming through. Are they small retail orders? Are they large institutional orders? Looking at our filtered time and sales again, and unfiltered time and sales. What's the type of the order? Is it the offer? Is it the bid? Is it red? Is it green? Which is the more aggressive side? Then we're looking at the bid and offer size. What's happening on the bid and offer? How is that changing? How is that? Is it decreasing when the speed picks up? Is it increasing when the speed picks up, both up and down? How does that interact? And then we want to see when certain things happen. So if we get small size trades coming through, what's happened to the bid and the offer? Is it moving? Is it lifting? Is more coming on? What about large trades? When we see large trades executed at the bid of the offer, what happens then? Lifted? Filled? More coming on? Exactly what happens. And then finally the response of the price to large orders. So big orders coming on the bid or offer, what happens to the price? Backs away, or does that get filled immediately? So when we take it one step further and we drill down to exactly what's happening in the market. Now, for most people, there are only two things that happen in the market. Either it goes up or it goes down. Okay, it could stay exactly where it is, but more than likely it's going to go up or down, even if it is only by a few ticks over a short time period. But for tape readers, we've got another two things that add to that list. Let's run through the four. The first thing is the buyers are more aggressive than sellers, and the offer lifts, which mean the market goes up. So that's a pretty standard definition. You've got aggressive buyers, they are hitting the offers are lifting, the price then goes up to the next level of offer, and ultimately the market moves up. That's just a standard definition, and exactly what happens when we see uptrends or markets moving up. That's all that's happening. And then vice versa, if sellers are more aggressive and they're hitting those bids, bids are finally being filled, moving to the next level of bid, moving to the next level of bid, that's pushing the price down and the market's going down. So that's two basic fundamental market movements. But we've got two more possibilities here for tape readers, which gives us that ability to look very closely at the in-depth price action and order flow and get a lot more information than those people just looking at charts. So consider now, when the buyers are more aggressive than sellers and the offer does not lift, the market does not move, what actually is happening? And vice versa, when sellers are more aggressive than buyers and the bid does not lift or the bid does not move and the market does not move. Now, this is where we get the potential turning points. This is the supply and demand. Now, basically, in the first example, buyers are more aggressive than sellers and the offer lifts, the market's going up. That's simple. There's just more demand than supply, or the demand is more aggressive than the supply. It's just pushing it, demand stepping up, taking that offer, it's moving up, vice versa for the sellers. But when we look at the example of the buyers are more aggressive than sellers, so they're hitting that offer, but the market does not lift, what can we deduce from that? We can basically deduce that the supply is matching that demand and we are in a temporary state of equilibrium, and that's vice versa for if sellers are more aggressive than buyers and the bid does not lift. We're in a temporary state of equilibrium. We're matching large demand with large supply. Really, what we've got is a seesaw. Great analogy for this. Really good to understand the concept of this in terms of tape. Now, we know what a seesaw is. Sits in a children's playground and it goes up and down depending on the weight of the person, depending on the force applied to each end of the seesaw. There's a pivot in the middle. Now, if we take that analogy and use it in the market, we've got two different phases. We've got equilibrium and we've got balance tipped. Now, equilibrium means that the market is stationary. Now, I'm talking within the relative nature of the movement prior. I'm not saying we're going to see exact no movement in the market, but I mean, if we've seen a 100-point drive and we're sitting in a 10-point range, that's pretty much equilibrium. So you've got to understand the concept of price and what's happened. So we've got equilibrium where the market's not going anywhere, and we've got the balance tipped where the market is either going higher or lower. Either the bears are in control, the bulls are in control. The aggressive side is winning, is leading the way. The price is going lower for the sellers, or the price is going higher for the buyers. Now the market has to go from one point to another. It has to go from balance tipped through equilibrium to get back to balance tipped. It may not stay long in equilibrium, but it has to go through that point for the balance to tip again in the other way. It may actually go from balance tip to equilibrium back to balance tip the way it came. That's what we call pullbacks on a trend day. So the balance is tipped in the favor of the bulls. We get a good push up. We get an equilibrium point, a little bit of consolidation, a flagging type pattern, and then it tips again. Or if we get a top, we get it tip, equilibrium, tips back over to the bearish side, and the sellers are in control. So what are we doing as tape readers? What are we actually trying to look at? We are looking for that equilibrium point. We're looking to spot that shift from equilibrium to balance tipped. Now, in an early example, we talked about supply and demand, and we talked about what happens when buyers are more aggressive than sellers, but the market does not lift. Now, that is basically supply matching demand. Now, at the top there, you can see equilibrium. Now, I've got two examples there. I've got equilibrium with two size arrows. Consider the blue arrow buying pressure, the red arrow selling pressure, or demand and supply. Now, a small arrow indicates small demand and small supply. Large arrow indicates large demand, large supply. So we can reach equilibrium in two ways. We can have no demand, no supply, and just nothing's happening, or we can have large demand but large supply, and equally they are offsetting each other and nothing is happening, which is what we talked about in our earlier example, that buyers are more aggressive than sellers. It appears that way. You're seeing streaming green on the time and sales, large orders, but the market's not going up. Now that's our case on the top right there. That's where our balance is in equilibrium, but there are two large sides competing. Now we're looking for which side is going to lift first. So this is when we start using our tape. We start looking at the time and sales and the dome to combine our feel for the market. We're seeing in that example aggressive buyers, but a seller is matching it. So if that seller holds and the buyer backs off, we can assume that the market's going to tip back into a state of sell pressure and move downwards. Similarly, if we're seeing that pressure continually hitting that offer and he lifts, then he is essentially taking away the size of that red arrow to a very small red arrow, and we're getting that drive up. So that's the concept of supply, demand, and using the seesaw analogy and how the market moves from balance tipped to equilibrium to balance tipped. And we know now that we are looking for that point. We're trying to pinpoint when the move occurs from balance tip to equilibrium and back again, and we're trying to look at that on the tape. So let's talk about some simple tape patterns that occur that help us identify that balance shift. Now the first one is change in phase. The two types of change in phase: there's change in speed of the tape and there's change in size of the orders on the tape. Now when I'm talking about the tape in this instance, I'm talking about the time and sales. Now we want to see the speed of the time and sales. We're seeing the orders scrolling through on the time and sales, both filtered and unfiltered, and we want to see what happens when we get an increase in pace. So an increase in pace, we would see the time and sales scrolling faster. We'd see it indicates a bit more urgency to the market. A lot more market orders going through, a lot more people agreeing on a price than previously. Now true breakouts have increased pace. If you've seen a genuine breakout as we break through a key level of support or resistance, you see the market running strong and the time and sales is running quickly. That's urgent orders, that's emotional order flow coming through. Now vice versa, a decrease in pace is just showing generally a lack of participation or price agreement. So you've got reds coming through, greens, reds, greens. It just is, just could be no action, just quiet trade, just no agreement on price. Now it can at certain points in time precede volatility. So you sometimes get this decrease in pace, almost the eye of the storm, before we get an increase in pace again. So it's very important to learn how to read the time and sales for the market that you're trading. Understand the general pace of the time and sales. Understand what is quick, what is slow, and don't forget it's all relative to what's happened previously. If the market's been extra volatile and then goes even more volatile, you're going to see a difference in speed of the tape than you are going from a very, very slow holiday type market to a suddenly aggressive non-farm payroll data, for example. So that's what we're looking for in terms of phase change speed. We're looking for the increase or the decrease in the speed of the tape. Now the second thing we're looking for in the time and sales, change of phase wise, is the size of the trades. Now we're looking at both our unfiltered and our filtered here. Is it retail or institutional activity? Have we shifted from retail commanding, or should I say dominating, the time and sales flow? So time and sales have been flowing along, ones and twos coming through in perhaps threes, fours and fives, to now shift to hundreds, 200s, 500s, thousands. Are we seeing a shift from retail to institutional activity? Consider this. Consider a fake out on a breakout. On a fake out situation, the market goes up. It appears to break through a level. You see a lot of retail coming through the time and sales. Ones and twos, threes and fours. Stops getting triggered. Market orders getting executed. Urgency on the retail side. But if you're not seeing that backed up with institutional order flow coming from our filtered time and sales, looking at the large order size, then who's buying? Who is buying that breakout? Are we going to expect to follow through? Perhaps not. This is information that we can use. If we know who's driving this breakout, if we know who's buying these new highs or who's not buying these new highs, then perhaps we can start to develop that into a trading edge. So we're looking for the shift from small trades coming through to large trades and vice versa. And again, it's all about context, it's all about the setup and where the market is and the price position relative to the day, to the week, to the year, to the hour. But we're looking for that shift, the change in phase that's giving us a clue that the market is potentially changing balance from balance, equilibrium to balance. So let's have a look at a few examples of tape speeding up or changing phase of tape. Here we've got the corn market, and you can see we're approaching the high now. I just want you to look at the time and sales really. On the left we've got the filtered on the top, and we've got the unfiltered below it, and there's the depth of market just there chugging along. Now you can see we've approached an overnight high, and as we've got there, we've just stalled a little bit. So just look at the tape now. You can see a little bit of red coming through, a little bit of green, a couple of seconds before each flurry of between each flurry of activity, and 4 seconds there before we had a trade going through. Another 5 or 6 seconds, bit more trade, bit of red, bit of green, bit undecided. Small equilibrium at the moment. So in the context of the setup, we know we're looking for some sort of drive, continuation drive to the upside. Then that's what we would be looking for generally on this sort of strength. And so what we're looking at now, time and sales. Let's have a look. Starting to see some green coming through. See the change there? We've got some 99s coming through, 113. Let's look to see if we get an increase in speed as well. So we know that every few seconds we've had an order come through. Sometimes we have to wait for 5 or 6 seconds before another trade to go through. Pretty much equilibrium situation, still within a range of a dollar and a half. But now let's look and see what happens as we start to approach the high. See when you can spot that there's a sense of urgency coming into the tape. You can see a sense of urgency from buyers. Now you see that. See the difference then? Lots of green coming through, little bits of red, as you're going to get. You're not going to get solid one way, you're going to get some sellers. But you can see small pauses, bursts, flurries of action, genuine breakout, levels holding, little bits of red coming through, not getting the expected response of the market pushing down with some red coming through, maybe getting a retest of prior levels, but finding the demand there again, and then again the tape running quicker, more aggression, pushing harder, seeing larger orders coming through the time and sales on the filtered, and genuinely seeing more urgency to the orders. So the change in phase, seeing the speed of the tape coming through a lot quicker than before. We saw the equilibrium point, and as we see the high break, we see a lot more interest. Now this is corn market. It's a lot different from the S&P, a lot different from crude oil and the YM and the Nasdaq, etc. It's a different ball game. But I wanted to show a couple of obscure markets. I've got a soybean example again next, just so that you're not clouded with perhaps markets you've been exposed to normally. So you can just see tape speeding up for what it is without looking at perhaps a price level that you know where the market went from because you're familiar with it, you traded it. So just something completely new. See now the tape speeding up again as we approach the high. Just general speeding up, general increase in the larger orders coming through on the filtered. So as I say, just different markets, just to get a feel for what it looks like when tape is running aggressively and changing its phase from, we saw it in the sort of mid-equilibrium point at the 740 741 level, and now we're up to the 746. We've just seen aggression, pause, and just noticing how that's flowing. So one more example here, soybeans this time. Now this is a little bit of a different scenario. We're just coming up to the soybean close. So I just want you to see how, we've been drifting around all day, as you can see on the beans, little push up, and I just want you to see how, see if you can spot how the tape changes its phase, its speed, its pulse, its drive when there is urgency by each trader. So, in other words, the close is coming up soon. No one wants to be stuck with a position. So, just watch, see this how the time and sales flows. See as we start to approach that 7:15 p.m. London time closing closing bell. See how the orders start to get more urgent. There's no specific setup as such, but just to see how when there's a sense of urgency, what happens to time and sales, so that you've got a benchmark. Again, with an obscure market, perhaps you've never seen the grains before, the beans, but obscure market, just see how the dome moves, how the time and sales responds, see what it looks like prior to that, and then watch what it looks like as the market starts to rush more aggressively. Right, so less than a minute to go, about 40 seconds. Look at the time and sales, speed increasing. Both sides, we haven't really got a specific side who's in charge at the moment, but you can see trades coming through, red, green, white in between bid and offer. We've got flurries of green, flurries of red. See how, because they've only got 20 seconds, 15 seconds to go, there's the urgency. So just note how the change in time and sales occurs. This is quick tape. Before the close was slow tape. See the change, see the difference. This is going to become useful in trading opportunities. In trading opportunities. So I talked a little bit there about expected response and what I call traditional thinking and expected response. Now we've got expected response and unexpected response. Now when I talk about expected response, I'm talking about what we see on the time and sales or on the depth of market and how we would expect the market to respond to that action. So some examples here, 6 examples here. If the tape speeds up and shows green, which indicates that there are buyers buying from the offer, green on the time and sales, the expected response is that the market would go up. You've got a lot of demand coming in. It's aggressive demand because it's taking those offers, and you'd expect those offers to lift and for the price to move up. Vice versa, if you saw tape speeding up and showing red, so aggressive selling coming in, hitting those bids, you'd expect the market to go down. Then let's think about what we can see on the depth of market or the dome. Now, before we move on to that, let's just think about what else we see on the time and sales. Moving ahead of myself there. Let's think of what else we can see on the time and sales. We talked about the tape speeding up. Now let's talk about what happens if we see large trades. And when I mean large trades, I mean large size. So we're seeing ones and twos going through. Then all of a sudden we see 50, 100, 500, or on the S&P, 1,000, 2,000. On that offer, green, large green on the time and sales, probably showing up on your filtered. The market would be, you'd expect the market to go up if that happened, wouldn't you? You'd expect it to see, you're seeing large demand coming in, that should lift and the market should move up. Vice versa, large trades hitting that bid, so we're seeing red, hundreds, 200s, thousands hitting the bid. The expected response is the market would go down. And then finally, let's look at the dome. What happens if you see a large buy order put on the best bid? So let's consider crude oil, where you may see 10s, 20s, and less on the bid. Let's say all of a sudden someone comes on and puts 200 on the bid. What would be the expectation of that? The expectation would be that the market would move away from it because they see that large order. They see what they believe is a large buyer tipping their hand. The market either pauses if it's going down, so if it's going down, it sees him, he stops the market, supports it, or it goes up. And then vice versa, if you see a large seller coming on the offer, what are you going to expect to happen? What do you expect the market to do? The market would perhaps back away from that seller. It would see that large order on the offer and back away. Now, That's the expected response. Let's move on to the unexpected response. This is a different way of looking at the market. Now, when you look at the market and look at tape and look at time and sales and look at all the parameters that you use to trade, it's helpful to think of things outside the box. It's helpful to think of things. Okay, what would you expect to happen to the market? What may happen? Who's going to be caught? And what would happen if the opposite happened? I know talking about a lot of happenings going on here, but consider when you get a fake out to the upside, bulls get sucked in, it's a trap, it gets pushed lower, they're all trapped. Not only have you got the sellers who are lurking beforehand, but you've got all those who bought that buy running for the door. So let's consider now unexpected response, and let's be aware of the complete picture. So what happens, we're going to use the same examples again. If the tape's speeding up, as we saw in our soybean example, as a corn example, showing lots of green, but yet the market goes down. Okay, what does that actually mean for us? Now, this is really useful information. Now, expected response is traditional tape reading. Okay, markets going up, green, loads of time, green coming through the time of sales, big orders coming through the time of sales. That's what you probably read in the 101 of tape reading or whatever. But you've got to think of it in a little bit better than that. You've got to think a little bit deeper, keeping it simple, but thinking what happens if the tape is speeding up and it's showing lots and lots of green, lots of aggressive buying, lots of buyers hitting that offer, but the market isn't going anywhere. The market, or maybe it's not going down, maybe it's just sitting there. That information? That's a lot of useful information, and vice versa. Speeding up, loads of streaming red hitting the bid, aggressive selling coming in, but the market doesn't move, or it goes up. That is really useful information. Unexpected response. What is that telling us? Let's use the example of the number one. Tape speeding up and showing green. Aggressive buying, hitting those offers. Expected response is the market goes up. What if it goes down or just stays where it is? Let's just drill into that and find out what's happening. So, aggressive buyers, we've got that. We've seen that on time and sales. They're hitting the offer. But if the market isn't going up, or if it's going down, it means that offer is not lifting. It means that despite the time and sales showing green, streaming green, there is a seller soaking up all of that demand. Now that is useful information, because what happens now in the next phase, if that then stops, if that buying then stops and that seller is still there, what do you expect the next movement of the market to be? If he's soaked up all that demand and there's still an overhang of supply, what happens? You can expect the market to push down. So if we don't get a response that we expect, look for the alternative. Think of all the people who have been buying that. It's not moved, he's not lifted, he's still got loads of supply there. Where's the market going to go? Okay, moving on, let's think about large trades at the offer. It's the same thing. Aggressive buyers hitting that offer, streaming green, large size, hundreds, 200s, perhaps thousands on the S&P. But if the market's not moving, there is somebody soaking up all of that demand. There's an overhang of supply. Once that demand dries up, where's the market going to go? It can only go one way. Now, of course, it can lift. It can be hit, and then lift. So we've got to be aware of that as we're watching on the tape. We'll show some good examples of that. And let's consider finally on the dome. We thought about expected response where a large buyer comes on the bid. Large buyer comes on the bid, you'd expect the sellers to get scared and think, okay, there's a guy showing his hand here. He's stuck a big order. We use crude oil as an example. The market moves away from it. But what happens if the market hits it? What happens if someone does stick an unusually large order on crude oil, 100, 200 lots, and it gets filled immediately? What information are we being told from there? We're being told that not only is there a large buyer willing to buy on the best bid or whatever he's put his order, but there's a seller who's been waiting for that liquidity. Now, not only have they taken all of that, but more than likely, if they've taken it all, they want more. So we're getting information now, and if another large buyer comes on and he gets sold immediately, but then a large buyer doesn't come on, what's that telling us? It's telling us that despite that aggressive demand, despite somebody showing their hand, and it's been filled immediately, just like that there is supply there, sellers there, waiting for that liquidity to take that liquidity. So it's worth noting when you get an unexpected response to something, you should pay attention. And obviously, depending on where the market is, the position of the market, are we in uptrend, are we in rotational market, where has the price just been? Is it in a trade setup? What has actually happened? Are we seeing, perhaps we're seeing that large seller at resistance, but it gets filled immediately? Can we expect the resistance to break through? Perhaps we can. So think about what you're actually seeing on the tape. Unexpected response. Is it unexpected response? Is it expected response? Is it traditional thinking, green going up, red going down? Or is it being aware of the complete picture? Taking what you're, this is why it's so important, guys, to see the depth of market and the time and sales. Because if you're seeing the time and sales go green, and you're not looking at the depth of market, you're expecting the market to go up. But perhaps there's a seller there who's just soaking up all of that time and sales, all of that green, and he's still there. The time and sales then dries up and starts to flick red a little bit. What do you think is going to happen? Unless there's a new flurry of buying to take him out, then we're going to get a push down. That's why it's so important to use the depth of market and the time and sales, combine the two to get that complete picture. So I'm going to divert very slightly from the tape reading theme just for 20 minutes or so. I couldn't release this program really without discussing about the cycle of the trade cycle, and how really to integrate tape reading into your trading, or how the best way to utilize the skill is. So really, to me, we've got four parts of the trade cycle, and this is how a trade, in my view, is created. Excuse me, is created. You've got the market, you've got the price, the depth of market, time and sales. Now, first off, we're looking at the market. We're looking at the market as a whole. What type of market is it? Is it a rotational market? Is it a trending market? Get the market type. What's the volume like? What's the engine of the market? Is there fear there? Is there greed? Just get that feel for the market. Then we look at price. Where's price relative to today's range? Where is it relative to yesterday's range? Where is it relative to the week's range, the year's range, overnight range? Are we at the high of the day, the low of the day, the open? Have we moved? What sort of excursion are we? What's the gap level? All this stuff needs to be taken into consideration. Okay, and that will create our trading setup. Now we'll have a trading library of setups, and I'm going to run through just some very basic fundamental setups, but setups that I use as a foundation to build on, and setups that work well integrating with the tape. So I'm going to talk about how to integrate the tape with those setups, and then hopefully you will get an idea of how to integrate tape with your own setups, or even use those for yourself. So those on the right hand side there are my trading setups, and then I then look, once I've identified a potential setup, I then look for a tape pattern. So I start to then look at the depth of market and the time and sales. Now we're going to go into more detail about simple tape patterns. We're going to go into more detail some advanced tape patterns, but those are the things that I take into consideration before taking the trade. It's one big cycle. It's a constant review of the market, the price, the depth of market, the time and sales. Now once I've identified the setup, I only need to keep reviewing the tape. But it's important that they are included as part of the general feel for the tape. You can't just look at one without the other. There's no use just looking at the tape without putting it in context with the setup. There's no real use of just taking a trading setup unless you're fine tuning it with the tape. So let's move on and briefly discuss three fundamental trading strategies. Now these are three families of trades, call them trading strategies, and then with each individual strategy you'll have a specific setup, and you can go as advanced as you like with these setups, but fundamentally they're all based on the same foundation. Now the three I've labelled here are key level reaction, continuation, exhaustion and flushes. Now strictly speaking, they're probably not quite correct, because there's some overlap between key level reaction, continuation, and key level reaction, exhaustion and flushes, as you'll see. But generally I think it's the best way of approaching trading, developing your trading setups, developing your trading strategies, and then integrating tape, because I couldn't really do a tape reading course without talking about how to integrate the tape with some specific strategies. And it's all very well me saying, oh, with the first pullback strategy, but if you don't know it, you haven't seen an example of it, you're not going to know how to implement it. So I'm going to run through quickly with some chart examples of some basic trading strategies. Now let's run through the key level reaction first. Key level reaction to me is, how does the market behave as it approaches a key level? Now a key level to me is either support, resistance, something like yesterday's close, yesterday's high, yesterday's low, today's high, today's low, perhaps today's open, the VWAP, which is the volume weighted average price, institutional benchmark, or just a psychological level, perhaps 11,000 on the Dow cash, or $100 on oil, or $2,000 on gold. You understand, you get where I'm coming from with that, the psychological level that everybody is looking at. What's the reaction to the market as it approaches that? We've really got two options. As the market approaches a key level, or in fact, we've got three options. We either sit and do nothing, which is the first option. Second option is we're looking for a break of that level, which is where our breakout comes in. And the third option is we're looking to fade that level. Now, obviously, that's simplifying it a bit, and we want to use the tape to gauge really how the market is reacting to the level. Is there a lot of aggression to break through the level? Does it look like it's a bit of a fake out? We just take out a high and then reverse. Is it going to stop dead at it? Is it going to consolidate at it? These are all little clues we're going to get from the tape. And key levels play a big role in my own trading. So, continuation, exhaustion, and flushes. Continuation to me is a good solid move, followed by continuation in the direction that move was going initially. So a good move to the upside, a small pullback, a small flag, and then a continuation to the upside again, or a breakout. Good push up, comes up to a resistance level, struggles to get through, then breaks through. That's a continuation. So just taking a trade in the same direction that the market was driving. And exhaustion and flushes are a little bit of a different play on key level reactions. Really, they tend to happen at the end of a trend. Sometimes they can happen when you're in a range, and I call it a range spoof, where you can imagine you're in a range and the market breaks to the upside, fails, fakes out, and then comes back down, and that's a bit of a flush out, just to trap a few bulls in and then reverse hard. That's very similar to a fake out. Perhaps not in a range, but it could be at a double top situation, could be at a key level, anything like that, where it breaks through, then fails to break, and then reverses hard. And retail stops. Now, a lot of the times on trend days, you get the max pain level, where the market will push, and really you just see that last bit of volume coming in, a good volume bar, a good size candle or bar, whichever way you're looking at it. And often, if you're using the tick index to trade the indices, you will see a spike. In other words, it's a bit of a panic. So a flush, or an exhaustion, should I say, is more of a panic. It's the last few buyers or sellers, depending on which way you're looking at it, to get out of their position. And often, if you can pinpoint that on the tape, when we see that sort of action on the tape, then we can really fine-tune our entry and get a potentially great trade from it. Okay, so let's run through now a few of the trading strategy examples. I've got about 13 slides here, and I'm just going to run through each briefly. I think you probably know what I'm talking about when I talk about some of the trading setups and strategies. So I'm not going to go into too much depth about stop placement or this and that. That's really another course, and we want to focus really on the aspect of tape reading, where we tape reading, what we're looking for, how we're looking for it. So run through these quickly with some examples, different markets, all the trading strategies, and then we'll talk about how we're going to integrate the tape with those. So flags, they're pauses in the market action. If you think about what a flag actually is, and that's very important, in trading, to think about what is actually happening when patterns are being formed. It's basically buyers or sellers, depending on which direction you're going, and waiting for a bit to see if they can get a better price, and then they get impatient. So they get into this situation where, if you consider this example in front of you here, Crude oil on the left, nice little flag pattern, good drive up, a pause, and then a continuation. You've got the push up, you've got that demand coming in. The demand backs off a bit just to see if any supply comes in. Any supply comes in, not much comes in. It really doesn't. There's a little bit of a pause there. You've got about 5 or 6 minutes of consolidation before buyers start getting impatient again, and then start buying, and the supply is not there to match that demand, so they have to start taking higher prices causing the market to move up. A little bit of a shorter time frame here on the Dow. We've got two Dow charts here, the one in the thin one in the middle, that's a really small consolidation, 2 3 minute consolidation. Literally all that is sellers backing off. There's no buyers there. If you think back to the seesaw model, that's really definitely an equilibrium situation. You've gone from very, very weak bias market to equilibrium for a few minutes, no buyers, no sellers, or very few buyers, very few sellers matched, and then a continuation in the direction where it came from. And then finally, the chart on the right there, this is even shorter, sort of very, very small flag. I almost call it just a pause. Good drive down on the Dow, little pause, slight push up, sellers very aggressive, straight back into that, considering that little push up as value. Really no buyers to overcome that supply coming in, not much demand, and then you see the final two candles, especially the last one, driving down. And actually, it's almost an exhaustion candle. That the way that volume has spiked, the size of the candle relative to the move, that could almost be considered an exhaustion. Okay, so here's crude oil and the euro. Some bear flags on crude oil, bear flags on euro. A little bit different in shape and size, but ultimately the same thing. When we think about what a flag actually is, and let's think about a little bit more how the tape can be read with a flag pattern. We've got an obvious imbalance. In both of these examples here, big imbalance to the sell side, to the downside. Drive lower, sellers back off, or buyers step up, and we get an equilibrium point. And the crude oil version on the left there, it got a several minute equilibrium point, 5 or 6 minutes. Well, looks like more 10 actually, 10 minutes. And on the euro, you've got 2 or 3 minutes. And often the weaker the market, the less time it will take to consolidate. So on the tape, we are looking to see when when the balance point begins, so when the equilibrium starts, and we can see that on the chart, so we're not too concerned about looking at the tape then. But then when we're in the actual flag itself, at that point then we're going to look for the balance to shift back in the direction of the sell side. So either expected response, or we're going to see the tape speeding up again, or we're going to see large offers coming on, or we're going to see large sells hitting that bid and the market moving back in the downside direction, or unexpected response. So we see buyers start to hit offers, start to hit offers, but the market does not go up. So in the context of the flag, if we're seeing that the market's not going up, there's a seller, passive seller, sitting on that offer, or offer plus a few ticks, whatever that may be, and there's aggressive buying. So we're seeing green on the time and sales, we see big size on the time and sales, but the market doesn't go up. That's our unexpected response. That's when we can then look to perhaps initiate a trade in the direction of the move, so in this case short side. So more on that later. We'll show some live examples of tape with that, but just start to think about the concept of integrating tape reading with these fundamental basic strategies. So next little example here is pullback. Now pullback and a flag, they are very similar, very similar should I say. Really, a pullback is a move in the direction, back in the direction it came from. Some are shallow, some are longer term, some are short. A flag really, they're very, very similar. A flag is more of a consolidation, a shorter consolidation. A pullback is generally where the sellers back off, or in the case of this apple on the right hand side here, you've got the sellers backing off, buyers stepping in, and then the sellers resuming again. So they're allowing the market to lift up a little bit. On the left hand side, you've got the same, but vice versa. Uptrend, pullback, and same thing with the tape. We're looking during that pullback. Once we've identified strength or weakness, we're then looking for the pullback to occur. Then we're looking at the tape for the expected response back in our direction, or the unexpected response where we're seeing something aggressive on the tape, but that's not leading to what we'd expect to happen in the price. Then we can initiate our trade with these fundamental and foundation setups. Another nice pullback on gold GLD ETF. Um, Lovely pop up, nice little pullback, pause to some support. So you know your support already. You're looking at the tape, and then we're going to confirm whether the continuation's back up to the upside. Moving on to breakouts. Okay, now this crude oil example here, 101 level. And now that asserted itself as a resistance before the pit open. We had a breakout later in the day with volume. So tape, what we're going to be doing with that, we're going to be looking for, as the market approaches that, what's the strength of the tape? What sort of speed are we seeing on the time and sales? What sort of size are we seeing on the time and sales? What sort of offers are we seeing? Are we seeing size on the offer that's being hit and then lifting? What sort of action are we seeing that are allowing us to confirm the breakout? Often you're going to get volume at breakouts. Now that's really buyers, in this example, buyers overcoming sellers. There are sellers there. That's what caused it to back away from that level several times earlier in the day. But then later in the day, the volume comes, the buyers overcome it, and then we get that follow through. Another example here, again, crude oil, psychological level. And it was actually in the thin after hours market. The $100 level was tagged the prior day. Loads of people watching it. This is a psychological level for crude oil, $100 a barrel, and you can just see there how visible that would be on the tape. As it broke, the book is very, very thin after hours, and if there are market orders hitting those offers, and there's not much liquidity there to soak up those market buys, then the price is going to move up aggressively. Okay, so those are breakouts, pretty standard textbook stuff really, but just thinking how we're going to look at the tape, how we're going to integrate the tape so we can pinpoint these breakouts and almost decide whether yes it's going to break, no it's not going to break, or hey we're not sure, we're going to stay out of the market. British pound here, little example, obvious support, great support, very strong intraday support, holding 1, 2, 3, 4, 5, 6, 7 times. A lot of strength there. So every time it approaches that level, we're looking at the tape. Now, what do we want to see on the tape? We want to see, are there any sellers is the first thing we're looking for. If there are sellers and there's red coming through, what's happening to that bid on the depth of market, on the dome? Is that moving? If it's not moving and the sellers are coming, he's obviously going to sit there, he's going to hold it, we're going to expect to pop off. Perhaps something else happened. Perhaps we got to that level, sellers completely dried up and buyers stepped in. You see there's two different ways market can reverse, or should I say what we can look for on the tape to identify when the market could potentially reverse. So let's run through a few more examples, and then we'll some screenshots here, and then we'll get down to some actual tape setups with some good examples of tape action. Another example here, crude oil, and despite the uptrend here, a nimble scalper, if you're looking at the tape and you're reading the level, you're looking at the response to the level, looking at the time and sales, there's a short setups there despite that being a pretty aggressive up move from 96 and a half all the way up to 99. So that does show you that you can use the tape in a variety of ways, and if you prefer to fade markets, you're looking for that balance point to then shift to the downside and for the tape to confirm that. A few more examples. Mini Dow, yesterday's high and low close, yeah, they're watched by most. It's well worth putting those on your charts. You can see this here. Dow pushed down very, very aggressively, actually, to the prior day's high, and you can see how key that high was. Not only was it the prior day's high, but I've circled in red there the amount of times we tagged that sort of level. So a lot of people watching that Definitely a level you want to be looking at the tape. You want to be seeing that selling drying up and just watching for that seesaw to shift back into the buy side. Now see, we've got a little pause there as we pop back up. There's a small candle of red, so you're definitely watching the tape there to see if the sellers took control of it again, or drove it higher. So these are part of the key level reaction family, and fading key levels, or looking to see the response at key levels. Okay, next key level I like to watch a lot also is the VWAP, volume weighted average price. It's often used by institutional traders, so it's well worth watching. If you're in a downtrend, pulling back to the VWAP, that's where we want to look at our tape for a key level reaction. Last couple of slides with this, from the exhaustion and flushes family. Now this is when you're waiting for that max pain. You're waiting for the max pain level. You're looking for the market to drive lower, drive higher, really large candle, perhaps form a wick. If you're using volume, you may see a volume spike. If you're using the tick index, you might see that spike in one direction. If you're trading the indices, it's basically the last few orders that are executed in panic, either get me in or get me out, depending on which side they're positioned. And this crude oil, once that 101 breaks there, a lot of stops under there, a lot of emotional orders, drove it down. Looking at the tape, the book will tend to go thin. Show some examples of it in a moment. The book will tend to go thin. The market will run down, all the stop orders will be hitting those bids. You create a bit of a vacuum because people haven't had time to put their offers in to fill that gap where the bids have been taken. So you tend to get quite a vicious snapback. And if you're really watching the depth of market and the time and sales, and you see that, and then you see no results, no additional selling coming in, that can be the mark of the bottom of that move. Quite a powerful setup that. So that's from the exhaustion and flushes family. And another one, which this is what I call a range spoof. Again, this is the sort of thing you're looking for on the tape. Very profitable trade if you can get this right. Got a nice range there. This is the Nasdaq. You can see the top of the range drawn by that thick grey line, and the bottom of the range. We just poked underneath, formed a little bit of a wick, and then found a lot of buying. A lot of buying. So what are we looking at on the tape? We're looking to see what the time and sales are looking like as we poke under. Are they streaming red? Most importantly, is the response as expected? So is the market continuing to push lower despite aggressive selling coming in? If it's not, then we can perhaps look for a fake out opportunity, a range spoof opportunity. If it is and the market is continuing to push lower, let's not fight it. Stand back, unless you were planning to trade the breakout. Stand back and look for another opportunity. And that's pretty much similar with the retail stops as well. This is Amazon here. You can see how it drove up very aggressively, broke that 173 psychological level, take out the retail stops, and then reverse sharply. Very obvious on the tape, that sort of pattern, because you're going to see small size coming through above that 173. So small share orders coming through, and then it's just going to stop. You're going to get that small pause, balance point, and then what's going to happen? You're either going to get continued buying, which is genuine breakout, or no more buyers. No one considers this as value anymore. Sellers just step in immediately, and then we get that really aggressive push back down, back to lows. Okay, so we've been through some simple tape patterns. We talked about the speed of the tape and expected response, unexpected response, that sort of thing. So obviously they'll take some time. It's worth taking some time, should I say, to watch the market, to keep an eye out for those sort of patterns, and just get used to the fundamentals of the tape, the speed of the orders coming through, the size of the orders, what's happening on the depth of market in relation to the time and sales, all the sort of stuff that we talked about earlier. But now I want to move on to some advanced tape patterns. Now I call them advanced tape patterns. They're really very similar to the sort of movement you'd expect from the simple stuff we talked about, or the foundation stuff we talked about, but really just going one step further. And what we're actually specifically looking for within each trade. So there's three advanced tape patterns I want to discuss. One's an iceberg or icebergs. The second is what I call holding, and the third is what I call running strong. Now, each of these can be used in individual circumstances. Icebergs are going to go through some deep depth next. Holding is really how the tape is responding if a level is being held. So it coincides with our key level reaction trading strategy. So we're at support resistance and we're looking for clues on the tape that show us that that price is holding. And the final advanced tape pattern, running strong, is the continuation. And within that, we've got the pause. So within the continuation family of trades, what we're looking for specifically on the tape to confirm that the market is running strong. So let's move on to icebergs. Talk about icebergs. Now, what is an iceberg? Now, an iceberg is an order which displays a small amount relative to the size that it's trying to fill. So pretty much like an iceberg, you've got a large chunk of it under the sea surface, under the surface of the sea. You can't see it, and you've just got the tip showing. So when you look at an iceberg, you can only see the tip of it, but there's a larger chunk of ice underneath the surface of the sea. So that's pretty similar. That's why it's called an iceberg. It's pretty similar to what we see on the dome. Now, the best way to describe it is to just go through an example. Let's use a 200 lot buy order example at a price of 104.26 on crude oil. Now, how would you execute that if you were a trader? You had to purchase 200 lots at 104.26 for whatever reason. What would you do? You could use a market order, put it all in at once, and you're going to move the market with that sort of size. You're going to get a bad fill. You're going to get some slippage. You're going to take several levels of offer with that trade. You can work it manually. Now that's time intensive, especially if you know that that's the price you want. If you're trying to work an order over several prices, then yes, possibly you would want to work it manually. But for this example, we're saying, okay, we want to buy 200 lots only at 104.26. Now, it's unnecessary to do that manually if the price is predetermined, because we can use an iceberg. Now, what does an iceberg actually do? An iceberg consists of several parameters. It consists of the price that that you want to do the trade, so the limit price, the size of the trade, obviously the direction of the trade if you're buying or selling, and how much you want to display at any one time. So in other words, what is above the surface of the sea. Now, a standard iceberg, what you would do is you would set it 200 is the amount of lots I want to buy, and I only want to display one lot at a time. So what happens is your iceberg will sit there at 104.26 on crude oil. If a seller comes to you and takes that one lot, automatically another one lot will enter and put itself on that price where you just were. So imagine it's been filled, comes back on, one lot. Filled again, comes back on, and it repeats that process until the full order is filled. So in our example, 200. So someone comes along and sells 5, it will do the 5, then it will load another one on. Someone comes along and does 199, it will do 199, keep reloading the one while it's being filled, then reload the last one. When the last one's filled, then it will lift off completely and you've got your 200. Really, we want to just discuss briefly before I move on to how to spot these and why I consider them to be beneficial. It's one of the best tape patterns out there in some markets, some specific markets. They're harder to identify in some of the thicker markets like the S&P, but we've got some examples of various markets. Crude oil, very common in crude oil. Institutional orders, generally, if someone's trading that sort of size and they've got access to an iceberg facility, it's an institution. So when we see an iceberg on the tape, we can make some certain assumptions that it's institution and that there is size to be traded. Now, this is my observation that 70% of the time they occur during continuation. So when the market is pushing strong and you get a pull back, you see icebergs often stepping in onto that bid and holding. and I'd say 25% of the time they're at key levels. So in other words, they're left at resistance or support or a psychological level until the order is filled, and 5% of the time they're just anywhere, anywhere, nothing, nowhere specific, should I say, more just in relation to where that trader or where that company wants to get completely filled. So, and I consider it a huge scalper's edge. If you spot an iceberg and you spot him and he's standing out from the crowd, from the noise of the market, from the depth of the market, from the time of sales, you've got a huge scalper's edge because you can position yourself accordingly based on A, the direction of the market, the sentiment of the market, and your bias to the market, and B, in position and where the iceberg sits in relation to that. Now, often on crude oil, especially when we had the crisis in Egypt, or not crisis in Egypt, the scenario in the Middle East where we had all the uprising in various countries and crude oil was really gaining a strong bid several days in a row. Um, Often the market would spike up, it would pull back, so you get that flag or that pullback type pattern. You'd see an iceberg, so you'd be looking to buy anyway because that's part of the trading strategy as part of the setup. You'd then see an iceberg sitting on the bid. You'd see sellers hitting him, but once you spotted that iceberg, you could effectively front run him and then use a stop just behind him. And I'm moving ahead of myself very slightly. Let's talk about the advantages and disadvantages of people, why people would use an iceberg and why wouldn't they use an iceberg. Um, so, why would you use an iceberg? Well, it disguises the true size of the order. Don't need to be involved in it. No human intervention needed. You plug it into your platform, put your required size in that you want to show above the surface, if you like, total size of the order, and then if that size trades there in total, you are filled. Done. Disadvantages, of course, strict price requirements. Okay, there's a possibility you could integrate it with another algorithm that moves that iceberg around and about. Or I have seen examples where the iceberg will, if it's being filled very frequently, it'll lift off to test liquidity to see if that supply or demand is there. And if it's not, it will come back on. If it is, it may put it on a few ticks higher or lower. Manual intervention needs to adjust generally. Stale icebergs can cost you dearly and picked off by expert tape readers. This is an opportunity really to talk about an old iceberg. Years ago, when I was trading shares on the London Stock Exchange, there's a share called Amvescap, and it was up with the FTSE. No specific news with it. The FTSE was up. FTSE 100 in London was up. Whole market was up, and so was Amvescap. Reasonably thin, not a very thick share, but enough to trade and quite a nice trading share. And you had a situation where, for whatever reason, I can't remember why, the whole FTSE came off quite aggressively, and all the shares obviously fell in line with the market. If that's how they'd gone up, if they weren't news related, they just fall off with the market. Except Investcap. Investcap was sitting there, so I pumped in Investcap, looked at level 2, and sure enough, there's one guy sitting on the bid, and people were hitting him. Now, this was a second tier stock, so institutions weren't necessarily on the ball with this, as if it was something like BP or Vodafone. And so the market was falling off quite aggressively, and this was still up something like 2 or 3%. And there was nothing but one buyer sitting on the bid, and he was reloading several thousand shares at a time, and people were hitting him. Now, they use this as an example because this was obviously a stale iceberg. He left that in. He wanted to buy Investcap for whatever reason, who knows, but he wasn't monitoring his iceberg. Now, of course, me spotting that, just hitting that bid, taking as much size as my trading strategy allowed, and of course, when he realised that he was the only person propping up that share price, he was just reloading. People were hitting him. More and more people started to see what was happening, realised that it was just one person propping up the market with a stale iceberg. Of course, he'd been filled, or he pulled it, and then the price just collapsed down to the level that you would expect it to trade at relative to the market. So really, a little story about how a stale iceberg, if it's not being monitored, I'm sure now they're far more efficient and advanced. And if that sort of thing, it's very easy for an algorithm just to take a look around at the market and make sure that they're not the only person buying. I'm sure he came back to that and thought, "Whoops, I think I've paid a premium for this sort of stuff." But that can happen. That can happen in markets. So how do we use them? Well, first things first, we use them in conjunction with our setup. So using some of those fundamental setups from earlier, the flag pattern, the pullback, key level reaction, that sort of thing. So really, as I said earlier, once we spotted it, we can front run the iceberg. So if we've got a flag pattern and we're looking to buy, for example, then we see an iceberg join the bid after a good move up, bit of a pause or a pullback, looking for a continuation trade. We see an iceberg come on. We can make an assumption: A, that he's got some size to trade; B, that he's an institution. So we can lean on his size, front run him, put ourselves in order, put ourselves one tick ahead of him, get our fill, and use a stop behind him. Now, the assumption obviously is that if there's no fill on his order, he's going to go aggressive. So if he's looking to buy 100 lots and he gets only a couple of them, he may well go aggressive and push the market higher. And also, you're getting a little bit of a gauge on the supply demand. If there's a bit of demand, then he's sitting there and there's not much supply hitting him. You can assume, or you can make some assumptions. You've got to make some assumptions in trading, and you've got to take some risk. Obviously, nothing's guaranteed. But we can then assume that perhaps the market's going to continue on because that supply demand imbalance is going to affect the price in the next few minutes or even seconds. Risk is limited because we can put our stop behind him. Several times in crude oil I've done that. I've seen a large iceberg, especially when we've had an aggressive up market. I front run him, got a few ticks ahead of him, and used a stop behind him. Now you've got to be cautious here because often, as I say, they will lift to test the supply coming in. If there's no supply, they'll come back on. So you may have to, be aware of that. But at the end of the day, you've basically got yourself a nice wall to lean on, a nice trigger for the setup, a nice way to play that strategy. Now, another less reliable method, and this is perhaps based on a breakout situation, and actually got a great example of this on the Dow. Waiting for that iceberg to get filled and then joining. So assuming he's the last stand, if you like. So very specific setups only, breakouts, things like that. So you see that iceberg there, you see, and actually it's very, very in line with the example I gave on InvestCap. There's an iceberg there, market was falling off, it looked like a great short, he was the last stand. Now obviously there were no bids below him, so I couldn't wait for him to lift. I had to actually take some of his price. But you're basically getting a little bit of a head start on the price because you're leaning on him effectively in another way, assuming that the market's going to break once he cracks. So how do we spot these guys? How do we spot them? Well, let's talk through an example. So, and I've got a great bit of footage as well, so we can see that live. So let's use a limit buy example iceberg as an example. The bid gets hit. There's lots of other size on the bid, so you're never going to find. Well, very rarely will you find that there's just one lot on the bid. After hours, you may do, and I'll show you that in a second. But let's assume there's a lot of people on the bid. Bid gets hit, and the bid size goes down to one lot. So you see the one lot on the bid. Then the bid continues to be hit. So you're seeing time and sales coming through red, but you're still seeing that one lot there. And you're also seeing, if you're using TradeStation or the broker, the histogram on the side of your depth of market growing. So the volume traded at that price is increasing slowly, but that price isn't moving. You've still got that one lot there, despite the time of sales being red. Expecting that price to trade through, it doesn't. You've got yourself an iceberg. So a little screenshot here. Took two screenshots and then we'll look at a live example. Here's an iceberg sell order here at 101.73 on crude oil. Now took a screenshot there. Timestamp there was 10:08:36 in the evening London time. So after hours, thin book. Now you can see a fair few have traded there at 101.73 already. We've got 2,117 traded. Now you can see on the time and sales got a lot of green gone through at 73. Now if we look to the right, a screen capture 20 so seconds later, we can see we're still seeing one there on the offer at 101.73, but this time the time and sales and the histogram is showing us that far more than one has traded at that price. So we've got ourselves an iceberg, and if we're watching that real time, we'd see that green on the time of sales come through, tick, 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 after hours, remember, so quite slowly. We'd see that 101.73 holding, not lifting. You'd expect the 101.75 to trade because that's the next level of price. So if someone put a buy in for 5 lots, you'd expect them to take one from that 101.73 and four from 101.75, taking the price of crude oil up to 101.75. That didn't happen. The one was there, it did not budge. We've got ourselves a sell iceberg. Okay, so before I move on, I want to very quickly show you this great little capture that I caught very recently, actually, and I've just sort of put this into the program. Great example. We've got a seller there, and he'd just been sitting there soaking up all of the bids. That's why it's so important, all of the buyers, should I say. That's why it's so important to watch the time and sales and the depth of market. You see on the chart, the first time we approached him, we backed off 10 ticks. Now, I couldn't capture it then, but I've captured it now. And what you'll see is, as he's sitting there at 11,450, loads of green hitting him. He's reloading 100 lots. It's an algorithm. You see as he gets filled, another 100's come on immediately. Now, it actually breaks through because the pressure is so great. We've got strength in the market. The ES is pushing on, the arbitrage opportunities there with the stocks or what have you. But the first time it touched him, it backed off 10 ticks, even despite us getting green, green, solid green. There's the break. You can see how it breaks. When the big level like that goes, you're going to get that pop up. Okay, this is a example of an iceberg on crude oil. Watch 106.28. We'll see it in a second now. The offer 9 now goes down to 1. Now look at the time and sales. Plenty going through green, showing one's going through. That offer is not lifting. We've got a small iceberg there at 106.28. We've got a situation here where the market has pushed up really aggressively. It's pulled back a touch and it's now attempting to take out some, well, it's attempting to push back up to highs. So we are looking for it either to burst up and to retest the highs or potentially some sort of lower high. We're up about 220 cents at the moment, $2, about 2% on crude oil. And so we're just watching the tape now to try and give us an idea, or try and give us a tradable idea, really. I think at this point in time we've got various options open to us. Keep an eye on 106.49. In a minute you're going to see a very small iceberg there. It's very small, it's very subtle. But if you look at the time and sales, you see there now we've got one on the offer. Let's see that time and sales. Plenty more coming through, not that many, but enough to denote that there's an iceberg sitting there at 106.49. Immediately sellers come back in. So, okay, we now know we've got a bit of information now. We know that there's a potential institutional order at 106.49, but we're also aware that on crude oil, there you go. See the iceberg there, a lot gone through there at 106.49, but he has not lifted. A good 20 or so traded there at 106.49, done 510 so far. So we can start to watch. Now what we're going to see is something that happens often on the thinner markets, and it's when the iceberg lifts to test the demand. Okay, it's lifted now, but he may well put in some orders. He may well have some orders resting at 50, 51, 52, 53, 54, etc. See there back on, we've got a lot of selling there at 50. I mean, we've got buying at 50 on the tape, on the time and sales, but there's a fair bit of selling there on the depth of market. So he's now lifted. That iceberg we saw there at 49 is lifted to see if this demand is still there, to see if the market will push up higher, because of course he wants to sell at a higher price as possible. So he's lifted now, he's just testing it. He may well have some more orders in here, but we're watching the time and sales, watching what's happening. A lot of green went through earlier, and the price is failing to push up. We've got a little bit of unexpected response there. So it's pulled back to our little 47 level that we were earlier, the 50 just below the. We're starting to push down a little touch here, 45. So we had a failed push up. Now we're trying to squeeze back up again. Look at this green coming through. Plenty of green coming through on the time and sales. Not so much on the filtered, but a lot on the unfiltered there. And we're not getting that push. So we're getting the unexpected response. So the market now, we've seen that iceberg. We saw the unexpected response. Opportunity to take the short for the market now to push back down, and all those buyers that were trying to push up for that failing, and those sellers taking hold of the market. Okay, so we talked about icebergs, and now I want to move on to a tape pattern that I call running. So what is running? Well, it's basically when the buyers or sellers are very clearly in control and are very clearly more aggressive than the other. So if the market is pushing hard to the upside, we've got green on the time and sales, we've got lots of volume coming through, we've got very quick running of the tape, we've got small pauses while the dominant side waits for liquidity. So on the tape, you may not even see them on a chart, especially if you're using 1 minute chart rather than a tick chart. You may see a good aggressive push up, a little pause, a little pullback for 5 or 6 seconds. You'll see on the tape a little bit of red, a little bit of a move down on the depth of market, and then a continuation back in the direction that the drive was pushing. Now this often occurs during a reprice. Now, a reprice is when something occurs that fundamentally changes the potential valuation of the market. So, if we had an interest rate, a surprise interest rate change, then bonds would move and be repriced. So would the equity market, and so perhaps would gold. So another example might be the non-farm payrolls. Another example might be the oil inventories for oil. So anything that changes, or for stock, for example, the earnings, something like that that changes the fundamental valuation of the market, and everyone's scrambling to push the market in one direction. So it's a genuine breakout, reprice. You get that really aggressive tape, really sharp moves, large candles, little pauses in the tape, little pullbacks, and then a resumption of the direction. So really, when we're looking at running, we're looking for the switch from price sensitivity to urgency. And what do I mean by that? Well, I mean that under normal market conditions, people will be putting in limit orders. They'll be trying to get a certain price within reason. They may stick to one price. They may stick to within a small selection of several ticks, prices across several ticks, should I say. And we're looking for the switch from that price sensitivity to complete urgency, where they go from I'm looking for a specific price to I just want to get in or get out, whatever it costs me. And we're starting to see market orders. We start to see very aggressive limit orders going very high bid, or the highest bid, or the highest offer, lowest offer, should I say. And we're just looking for that sense of urgency, that sense of panic, that sense of we need to get in quickly. This market is going without me, or if I'm already in, it's going without me. I'm in, I want to be out. Okay. So often large size will appear on the bid or the offer, and you'll get a situation where large size appears on the bid or the offer, and it's not filled, or it's filled partially. So how do we combine the time and sales with our market depth here? We look at the market depth. We perhaps see 100 lots coming onto the bid, depending on what contract we're looking at, what market we're looking at, of course. So we see that coming onto the bid, as an example. Could equally be the offer, of course. And we see a little bit trade at it, perhaps 3 or 4 retail sellers nibble it, but it doesn't get filled, and the market moves away from that order. Now, this is a very, very common bit of tape action. This is a very common thing you will see during a reprice. Large orders coming onto the best bid. We're using an example here of reprice to the upside, of course. Large offers coming to the best bid. They're not filled. They have to go up. They keep moving up, keep moving up, keep moving up. The market's moving away from it. There's just no supply coming in at all, just constant demand. They are missing their fill, or they're perhaps getting a couple, and there's a couple of retail sellers hitting them. Eventually, the assumption is that he or she is going to have to become more aggressive with that order to get filled. and he psychologically represents a group of traders. So when you see that pattern, when you see the market running, when you see that large order or large orders coming onto the bid not being filled, perhaps moving up as the price moves away, still not being filled, impatience sets in, they're moving from the price sensitivity to urgency, and we're assuming they're going to have to get fully aggressive and perhaps go market with that order to get filled. And what we are doing is we're extrapolating what we see there with that one particular buyer, or could be seller, and extrapolating it into the group of traders. So thinking there are other traders out there who are trying to buy the limit order and who can't buy, and soon enough they are going to push the market to the upside, in our example, by using market orders or very, very aggressive limit orders, because they are not getting filled, because there is no supply there or very limited supply, and there's a lot of people after very little supply. And when you get that imbalance, of course, you get that push up, and it often occurs also at exhaustion levels at the end of a trend when it just seems like it's the maximum pain. People are trying to cover themselves on pullbacks, they're not getting it, they're chasing it, and that's when you get those little exhaustion moves where everybody is running for the door exactly the same time, and you're getting those spike candles, you're getting the wicks, you're getting the tails, you're getting the good moving volume. But running is the act of the tape and the market pushing very aggressively in one direction. Okay, so that's running. Now let's talk a little bit about what I call the pause. So what is the pause? Now, after the tape has been running, we want to know whether the market's going to continue to run or reverse. Now, don't forget to put it in context. If we're up at a key level, we perhaps may find some interest there. But if the key level is perhaps above us, talking about example of us running to the upside, then we could use that as a potential magnet, a potential target. So what am I looking for really with this pause, and what's the sort of setup? Well, you can have it over multiple time frames really, and when I say that I mean from perhaps a minute up to 10 minutes. I don't mean any longer than that. Uh, it's basically while the dominant side waits for liquidity. Now, it's the initial pulse. You're waiting for that initial pulse just to pause for a few seconds sometimes, perhaps a few minutes. A few minutes is more of a flag pattern, but the real raw pause would be waiting for a good push after a reprice, a little pause in the tape, 10 seconds perhaps. It's just while the dominant side waits for liquidity. It's just the volume, it's where the volume dries off, tape goes into equilibrium, time and sales, maybe ones or twos hitting the bid and offer. It's either storm, if you like. The shorter the pause, the more urgent, the more likely the next move is going to be extended. Because if there's no pause and they're not prepared to wait very long, then the likelihood is the next move is going to be explosive. So let's use a buy example after a good run high. So we've had a good push up, we've had a good running pattern, market's driven hard, we've seen green on the time of sales, we've seen large orders going through, we've seen offers being hit, very light red occasionally, if at all, and just a good solid drive up, leaving some nice good candles on the chart. So when we get to this point where we're about to pause, what actually happens? What actually happens? Well, bids will start to be pulled. So those aggressive bids that you've seen on the best bid, best bid, best bid, they'll just start to step back a bit, just testing to see if there is any supply there. You know, this has been demand fueled, and now they want to test if there's any supply. So they back the bids off. They step back. No offers are hit, or if there are, it's very, very light. It's very, very light. So just a few people hitting the offer, no aggression to it. And it's just basically seeing if any liquidity appears, because they want to get the best price possible. So they don't want to keep chasing. They want to back off, see if there's some supply comes in, moves the market down. And this is what we'll start to see. We'll start to see retail coming in, perhaps ones and twos. You know, the retail guys, I think it's at the stop. It's at the top of my chart. I need to go short here. Not reading the tape. They're not really clued up on what's going on, and so you'll see there's ones and twos coming, perhaps hitting that bid. So then we come to phase two, or phase three, if you like, of the pause. So the first phase is bids being pulled, everyone backing off the throttle, backing off, stepping back. Whoa, the market just comes to a little bit of a pause. Then phase two is retail. Retail comes in, perhaps hits the bid, perhaps knocks a few price levels of bid. Obviously, if the S&P, maybe not. If it's the YM oil, a few bids may get knocked back, and it may rock back just a couple of ticks. The phase three is when buyers start to realize that there is no interest at this level. There's no selling coming in. There's no severe selling coming in. There's no supply coming in. There's no size coming in the offer. So what do? They go to what I call the first stage of aggression, and they become passive, and they start perhaps putting a bid at the high bid. A large order. I mean, when I say a bid, at the high bid, or perhaps at the high bid minus a couple of ticks. So not ultra aggressive, but they want to be there. They want to buy now. They want to buy reasonably quickly, but they quite like to get a good price if they can. So they're really trying to work a price. You start to see some buy orders stepping on. Then the fourth stage, the final stage, which is when the pause is over and we're going to get the continuation, is when they then become aggressive. They realise that they're going to have to pay up to get that those contracts or that stock or whatever they are trading. It's no good them sitting on the bid because there is no supply there. There are no sellers aggressive enough to take those bids. They may sit there for a few seconds, and it dawns on them that they are going to have to start using market orders. They're going to have to start paying up. They're going to have to start taking offers. And of course, if that applies to numerous traders across the market, then that's when the momentum continues. Offers get taken, price moves up, momentum continues, and not only that, you've also got the fueling from, using the same example of a move to the upside, the short covering. You've got the people trying to get in, and you've also got the short covering. The people who are stuck short, they see the market pause, drive up, they're hurting, they see it pause, they get a bit of hope, they perhaps see it move down a few ticks, they say, okay, great. Then they see the urgency again coming into the buy side, they see it breaking the high, they then fuel further and further upside. Trapping the shorts and fueling that fire to continue that running pattern. Okay, so let's look at a little example here on crude oil. Now, crude oil is a very, very choppy market. So the example you'll see quite a bit of choppiness back and forth on the dome and on the time and sales. That's just the way it is. It's one of those type of markets. You can see now we're probing towards lows here. We've had a push down. We're down quite a lot on the day, actually 3.5% nearly. And you're going to see in a moment some real running. So we'll properly break. At the moment, we're just probing. We're just probing lows. Look at this, good volume coming in, and it's being supported at the moment. You can see it's just they're taking it down a few ticks, and then someone's coming in and taking a little buy order, a few offers. It's popping back up. Now we're popping back up here, and a lot of people would think double bottom. Now, a little tip really to consider is when we get this pop. So watching this pop now, everyone's thinking it's going to pop. If it then starts to revisit after that pop, then you can assume that sellers are perceiving that little pop as value and the move is not done yet. Something completely different, it's not unrelated to the tape, but when you've got that double bottom situation, it appears like a double bottom. If that doesn't bounce off pretty aggressively and starts to revisit within the same candle, then expect a bit more downside. So it's probing the low now. We're looking at the time and sales. We're looking at the filtered. A lot of red on the filtered up there. 20s, 26s. Not much green. So sellers are definitely in charge of this at the moment in terms of aggression wise. But they keep backing off. You notice how now we're seeing red coming through. A lot more red coming through then on the filtered, on the unfiltered. But they're backing off at the lows. Let's see what happens when they approach this next low. This is why trading, a fair bit of selling there at 105.60, and he's stepping down a little bit now. Perhaps they're getting a little bit more aggressive, backing off. There's no need for them to be aggressive. This is why trading breakouts, especially in a market like crude oil where it's choppy like this, is quite dangerous because of the natures of the move. It snaps back up quite a lot. So we've got a new pushing to try and make a new low here. A little bit of a sell iceberg there at 58. He's filled. Still got a fair few buyers down here. It's not a one-way street by any means. Definitely the sellers are more aggressive, obviously being a few ticks off the low. The longer it stays down here, the more likely it is that you're going to get the break, because all that demand is being soaked up by supply. And it's the same whenever you're holding at highs or lows, or a few ticks off highs or lows. If it was genuinely going to bounce off it, the likelihood, or most of the time, you would expect it to bounce off it relatively quickly, maybe revisit. But if it's holding, it means that sellers are still continuing to find to perceive this as value. Now they're looking for one more push. Here comes the time of sales coming in, breaking but not dramatically. Still some buyers stepping in, holding that. See, we had 180 soaked up at 52. That's making that's encouraging a few more buyers in, so they're just popping up. So we're not into the running pattern yet, but still, I thought it was included anyway, so we can see exactly what happens at lows. Sometimes not always clean cut, and especially with a market like crude oil, where it is quite choppy, and you'll get these spikes lower, spikes higher. But it's important just to keep your focus on the depth of market. Keep looking at the time and sale, see what's going on. Definitely some demand down here. Definitely some demand down here. You can see they've got some aggressive orders going on high bid. Then offers are coming on as well. So, but then look at this pop. Look at this little pop. This is where you want to watch to see if it continues. If we're talking a different market, different time frame. Sorry, not different time frame, a different time period in the market. Not this specific example. Any pops like that, if they revisit, expect some more downside. There we go. Now you can see some more aggression coming in. There's still buyers, still lots of green coming through, but the market is moving down. Notice in the filtered up there, we've got a fair bit of green. The majority is green, but the market is only 10 ticks off the low, telling us something already informing us. Got a lot of volume coming through here. Don't forget, obviously, this is the 2 o'clock, which is the London time for the oil pit open and the options. So now we are probing lows. We are really trying to push lows. Still popping back up. This must be frustrating retail breakout traders no end. That's the market's job. It's never easy. It can be simple, but it's never easy. So here we go again, pushing down, seeing 20 there at 58. He's going to get filled. A little bit more aggression now. Seeing those bids being hit. There's their red, streaming red. Right, now this is broken hard, good volume. Let's see, here's a little bit of a pause here. Now this is a little bit scrappy because it's crude oil. See there at 41. We had a 41 seller holding it, did 109. That was a little bit of an algorithm. It's going back up now to retest. Because it's crude oil, it's not a pause and revisit. It's not a classical pause and revisit. Again, they're testing that 40-41 level. Guys very interested at that level. But it's still a pause because they're just backing off a second. They've got those sellers, and they're sitting at 40-41. They've stepped off, they've tested liquidity, it's popped up a bit. Now they're stepping back in. We're looking for a revisit, looking for another further flush. There's that further flush down. Again, coming in aggressively. Very choppy tape, crude oil. S&P's not like this at all. But as it's crude oil, very choppy indeed. So that's a nice little example of crude oil. It's a nice little example of how actually it's an interesting example. The low, there's a lot of demand down there, not a one-way street. But when it does break, you can see when it breaks properly. It's a genuine breakout, you can see it. Then you wait for that little pause, that little tiny pullback. It pulled back very slightly for us, and had a few little tests. You could see there was a tape seller there at the 40-41, pulled back up to that, and then did a further drive lower, pushing into lows, showing that the sellers were definitely in control. Okay, this is the S&P 500. ES is the code on the CME, and a bit of background to the chart and to this tape. The open was a good gap up, gapped up above the prior day's high, which is the dotted green here on the 1 minute chart. There's a 5 minute chart above there, and also the day before that's high. So it's quite a strong open. However, it's pushed down. Apart from a few ticks higher, it's pushed down pretty much straight away from the open. We've got the depth of market here screen. We've got the time and sales here unfiltered, and we've got the filtered time and sales here, which is showing all the trades above 100 contracts, or 100 contracts or more, should I say, and they're grouped into the correct trade size. So what are we looking at? Well, if we were taking a short for this, one of the setups is perhaps a short for a range fill, looking for the market to come back into yesterday's range, or at least tag that range. So let's say we were short at the open, or we were short on that pullback, or even if we were short on the break, or even if we weren't short and we were looking for some sort of signal from the tape to make a trade. Maybe we weren't sure if the market was now going to find some support and pop up, or we weren't sure if we wanted to enter the short or not, looking for that range fill at 13.25 and 3/4 or 13.26 to be sure we got the fill. So what I'll do is I'll play the tape all the way through from start to the finishing point. Um, and I won't comment. We'll just play the tape all the way through. Then we'll go back and we'll dissect it bit by bit and see exactly what's happened. So watch the dome. Look at the quantities that's been traded at each level. This is the quantity here that's been traded at each level. Look at the time and sales. Notice the speed of that. Also look at the size of the orders going through and at what level they're going through. Don't need to pay too much attention to the chart, but just bear in mind that obviously there's the range fill there, and if we need to, there's our last swing high there. So let's get on with the tape, and I'll keep quiet. Okay, came up to our final target now. Waiting for the 26 to lift, and there's the range fill. Okay, let's rewind that tape, and we'll run through exactly what we saw there. I guess the first thing is that most people would see if you're watching closely, was the size of the orders hitting the bid, especially around the 27.5 point. Let's play the tape anyway, and we'll commentate as we're watching this. First things first, the 28 gets filled. The bid gets filled. But notice how it gets filled, which can happen. But it's what happens after that bid gets filled that's interesting. Do large offers come on? Does it get filled and then the void doesn't get replaced and then it's left in no man's land? What actually happens? So 28 gets filled. It then goes offer. It goes bid very, very slightly. Let's go back and look at that again. It goes bid very, very briefly, but not very much. Before the sellers exert their authority on the 1328 offer, which was the last low. So it was a significant point. It's a significant point, the fact that it's now holding at the low. You've got a few buyers stepping in there at 28. You can see just up there, 1,000 or so contracts traded at 28. Notice how this number's going up. So there are some buyers there. It's not a free fall market at the moment. But notice how the speed of these numbers are changing. That shot up to 4,000 pretty quickly. And now you're finding that this 1327 3/4 volume is really starting to pick up at a rate. Then the 3/4 gets filled. And notice how it goes offer with a reasonable size pretty much straight away. There's no real battle for that 27 3/4 level. And now we're looking and we're seeing the size of the orders going through. Let's pause it there. Yeah, you can see took out that 3/4, continued, and they hit the halves as well. So that's a market order, or at the very least, it's a 27.5 limit. They've taken all they can at 27.3/4, and the rest at the half. So that's a reasonable size order. It's probably grouped into this guy here. If I just get my pen out for a second, you can see that's the same time. That's the same time. Well, this is the same time anyway. So he's taken 1,500 at 27.3/4 and the rest at the half. So if you're looking into to that particular trader, whether it's him or her execution, what he's done or she's done, well, I'll keep it at he. What he's done there is he's been so urgently wanting to get into the market that he's taken the 3/4 and he's carried on and taken what he can at the half. He hasn't left himself sitting at 3/4. Now, that's not to say that doesn't mean anything, because just because you're executing a large order doesn't mean you're right. But what it does mean is that there's a sense of urgency more on the seller side than there is on the buyer side at the moment. And you can see how the tape is starting to get quicker now. So if we play the video, the half gets filled. The half gets filled. It goes bid very, very briefly. I'll show you that again because that's very important to see. Got the half bid, 2,800. The half gets filled and the bid pops up again, but it goes offer again very quickly with some decent size. Let's go back a little bit further so we can get the full picture of that. So we see the half, that's the low, 800 traded, takes a full 2,600, all fully traded. The half then flicks bid very briefly. Sellers perceive that as value, and then we're seeing a good 1,000, 1,200 contracts sitting on at the half. Tape is starting to speed up. We've got lots of red coming through, lots of 100 contracts hitting the bid there at the quarter. The quarter gets filled, immediately 1,000 contracts come on. That's what we're looking for. Again, the 7 gets filled, whole number gets filled, 1,500 come on. They are not being filled. Let's pause it here. The 3/4 has been filled now, another half. Notice how there's a sense of urgency starts to gather. You can see the size of these orders now as they're hitting the 3/4, the halves, the quarter, the whole number. These are big orders, but they're leaving residual orders on the offer. It's not like they're just taking the bid and then they're stepping back. They're taking the bid and they're leaving some on the offer. But the crucial point is they're not being filled. So there's no buying interest yet. So you're getting this running down situation where sellers are hitting the bids. They're taking everything they can at the bid. They're putting some on the offer. They're trying to get the rest filled. They don't get filled. It starts to run away with them. So then they go and hit the bid again. And then they start moving down and they've still got more to get filled. And if you've got no buying interest, then you get this crescendo that we've got now where it just broke the 28, 13.28, broke down, really started picking up momentum at the 27.5, and we're noticing that the market's not allowing it to go uh, to pop up at all. Any pop up, any slight pop up holds for no more than 30 seconds to a minute before before the sellers hit it straight again, and that price then goes offer. So here's an example now. Now we've got 3/4 bid. Let's see. The sellers may be thinking, have we got any value here? Straight away they come in, perceive it, got an extra tick, they can get an extra tick, and now you're seeing the offer starting to pick up again in size. Lots of trading on there, 3,500. They're still not eager enough to hit the half yet because they only got 750 traded. But soon enough, they'll start to get a little bit more. There you go. Then it goes. The half goes offer. You got the quarter bid. No buying. Pause it here. You can just see there in the last minute or so. Look at the predominant color. Apart from this little 1,000 buy here, at the 3/4. It's all been sells. It's all been sells, and even retail, the ones and twos are coming through and hitting that bid at the moment. So let's play the tape again. This is where it becomes interesting. Now the offer gets lifted. The offer gets lifted, and we go to 13.26.5. So this is the point now where you want to see whether there's going to be the continuation, whether the running on pattern carries on or not. So we'll watch the tape and we'll see how that bid and the offer respond. Notice that we've got 3,000 contracts traded there. Get my pen out. Got 3,000 traded at the half, 1,600 or so at the quarter, 3,500 on the offer. Now very interesting to watch that. So let's play the tape. Immediately the half goes offer. There's a little bit of buying, but notice it's retail buying, and that offer is actually increasing. Let me just wind that back again because it's an important point to notice that. When that half has gone offer, you've got 3,600. There's a lot of green here. The offer's not being lifted, but in actual fact, the offer is increasing. So people are seeing some buying coming in at the half, and the sellers are thinking, great, I don't have to hit the quarter, I can sit on the half. So we'll play the tape. A lot of buying coming in at the half. It's not moving. That number's not going down. If anything, it's increasing. It's gone from 300 to 500 to 700 to 800. If you see that, it's telling you something. It's telling you that even though there's a little bit of retail buying, it's not enough to make any movement. And then you start watching that bid. 2,900 on the bid. Still watching the offer. We've had another 900 traded. The bid gets taken. Immediately 1,000 come on. Now they're starting to hit the 26. We're getting close to the target now. You can just see the red coming in now. The final flurry as it just pushes there, and it just tags that prior day's high. So really, we're looking at several things there with the running down pattern. The break of the 28, which we see, then at that point we want to see, does the running down start? So the running down starts from 28 to 25 and 3/4. Now I know that range is relatively small, but most market days aren't wild and active, so we need to hone and tune our tape skills relevant to not only really wild swinging volatile markets like oil or volatile days, but also normal days like this when you've got a gap pattern, you're perhaps on the short side already, or you're perhaps looking for a little bit of a clue. Maybe you sold the break, maybe you're looking to sell that pullback, whatever it may be, but you want the tape to guide you. So what are the clues that we just saw there that would confirm our short trade, or even look for us to make a quick short scalp? First of all, there was the size traded at the 27.5. Lots of size traded, and more importantly, not only the fact there's a lot of size traded there on the bid, when it went offer, it may have flicked bid briefly, but the predominant move for that was that it stayed offer. In other words, people still wanted to sell, and that was the pattern all the way down. We had a couple of times where the bid was taken. It then went offer and then went back to bid again, but it didn't last long before sellers perceived that as a little bit extra value, an extra tick, and then hit it straight away. And then we saw the last thing that really cemented it for us, that it was going to hit our target. We probably wouldn't want to initiate a trade at that point, obviously, because if that was our target, then it's not far to go. But seeing that 6.5, there was 300 contracts there. There were lots of buyers hitting that, all retail. Not a lot of serious buyers. I think we had a couple of hundred maximum hit that, and it wasn't lifting. It wasn't lifting. In actual fact, that offer was increasing. So despite this being completely green and being quick green, to appear as if there's buying pressure there, what was happening is people were seeing the green, seeing the buying, and thinking, I will join that offer to see if I can get myself filled at the 26.5 rather than the 26.25. And of course, no extra buying came in. The bid, people started getting impatient, and of course the bid was taken then at 26.25. 26 went, crumbled, and it tagged the 1325.75. And then from then on, it's a different setup. We're then looking at whether the level's holding or not. But for the running on, not very quick. I do grant you that it's not a quick move. But with all the clues, you've got the clue there with the filtered time and sales. You've got the clue here with the speed of the time and sales and looking at the retail. You've got the third clue with how the dome's responding, especially how these bids and offers are responding, and how this size is increasing or decreasing, relevant to whether the bid or the offer's just come on, relevant to the speed and the direction of the time and sales, relevant to the size going through the unfiltered time and sales. So, great little example there running on. Um, not not a very quick example, but a key example because the market isn't always active, it's not always quick. But as you can see, if you pick up various things, then you get a nice little edge in, and that's what tape reading's all about. Okay, so just a few examples there of running on the S&P and crude oil. Going to have some more examples later on, some assorted examples which will include some running, but just to get an idea of the sort of thing we are talking about. I want to move on to the final advanced tape pattern, or calling it advanced tape pattern, and that is holding. So what actually is holding? Now, holding is basically when you would expect the market to push through, but it's literally just holding. We saw a little bit of that actually in the crude oil. It was holding at the lows. A lot of buyers there, being crude oil a bit scrappy, so it wasn't very clean. But often with holding, you'll see a buyer just literally holding completely firm at one specific level. The market's coming towards him, he's not lifting at all, and you can know, and that's if you're integrating it with a trade setup, that's the sort of time that you can notice a turn in the market and a swing point before they appear on the chart. So the expected response suggests the level's going to be breached, but the level's held cleanly, or is either within a few ticks. It might be within a few ticks if it's the YM or the Nasdaq or something like that. And it basically just takes all that supply, all that demand, and then everyone just realizes, whoa, this is the end of the move, and you get a sharp reversal. So look for the volume increasing, and look for the change in tape phase as it hits it. Look for that unexpected response. The expected response doesn't happen, so we get unexpected, and then we're going to look, and you see how the market then backs off that because it's perhaps already stretched, already seeing that people are thinking, oh, that's the end of the move, and then there's a bit more of a panic in the opposite direction. This is silver, July silver, 2011 July silver, down 7% on the day, very strong down day, and it has been quite a move from the top, as you can see up there on the I think it's a 15-minute chart. The high was at $49, and we've just literally collapsed from there. So we've got a lot of people running for the door at the moment. Anyway, I've started the footage just as we're about to break this low. We held once, twice, and now we've actually just started to break it. Volume's picked up. Now the silver's a very thin market. You can see here ones, twos, threes, fours, etc. But you do get a reasonable amount of trade. You can see there hundreds, 50s, so a lot of algorithms dominating that. One thing I wanted to note actually before we play the tape is look here, 382 contracts at 39.50. Now normally I would be a little bit cynical of a large order like that sitting there, but as it's at a whole number, and as that's only just come into display after the break, now you wouldn't have been able to see that before the break, so there's no benefit in terms of pretending that there's liquidity when there's not. So I would be aware of that, and I'd be looking at that, and I'd be looking to see how the market responds as we get to that. So let's play the tape now. See how gappy silver is. Um, so now we want to see how it responds if it gets down to that 50. 384 there, remember, 383, call it 383. 216 trade, 270 trade, solid support. Solid support, 289 trade, another 90 on the bid, 300 trade, 400 trade. So they fill that order. Notice how that order has been filled, but more has come on. And so the natural reaction then is for the market to spike back up. So knowing ahead of time, potentially, whether there is a large order, whether he's genuine or not, having a good feel for it, understanding what happens, seeing it in real time. So we're seeing him being hit, we're seeing him not move, not even move down by a tick. And of course, when we see that, especially when we get an exhaustion type situation like that, then we can position ourselves accordingly. Now I'll play the tape again because it does come down for one more revisit. You can see how jerky the dome is. Trade station is actually struggling to keep up, centering at the right level. We've had no serious size coming through, so these are all lots and lots of ones hitting the market, causing it to go down. But you can see how thin the book is and why that's happening. So he's a line in the sand. Very, you can see on the volume bars how large he is relative to the rest of the trade, and look at his relative position on the chart. So it's coming down for a revisit. A little bit of defense there at 39.60. 100 lots now traded on that level. You can see at the whole numbers 50, 40. There's a bit of level. Now we're seeing him being hit. He's being hit again, and it's popping straight back up. So he's basically holding it. We don't know if it's one guy. We're assuming it is because we saw that 383. It's traded a lot more than that now, and twice he has held silver. Now, from a perspective of a trade idea, I would be nervous of the third visit. The first time you spot something like that, if he's holding in the sand, then obviously your risk is very quantified. You're going to get better slippage if you do decide to fade that. But you can see the sort of pops that you get from those levels when shorts realise that there isn't any further to the downside for that short time period, and there's a little pop happening. I would be cautious the fact that we're down 7%, the fact that we are, there's a lot of liquidation and the story behind the actual trade. But from a tape point of view, it's a great example of just seeing how, if there is a trader sitting at a key level, in this case on the buy side, soaking up all that supply, just sitting there, passively sitting there, reloading his orders, not allowing it to go one tick under. So there you've got a great risk reward opportunity. If you're a scalper, if you're aggressive in nature, it doesn't get any better than that. Okay, this is a nice little example on the corn market actually, a bit obscure. Not many people trade the grains. But have a look here. We've driven down aggressively from the open. Two good drives with a little flag there at 755, and now we're just approaching this level here. 747 and a quarter, 747 and a half. Look at the histogram to the right hand side of the price. The histogram is showing you the amount of contracts traded at each price level. Look at the cluster of volume we have from the low tick up to around 748, significantly more than most of the levels above for what all I can see on the dome actually. So this is really a good example of holding, but not actually at one specific price. You can just see a general interest in buyers down at this level, and sellers are still there, of course, because to create volume you do need a buyer and a seller. So there are sellers still hitting those prices at the quarter, 747 a quarter, the half, the three quarters, 748, even the low tick, but they've not allowed it to go one tick lower, and you can see there's just an accumulation going on. So we have, if you think back to the seesaw analogy, we have the market in balance at the moment. uh, but it's one of those where you've got the big blue arrow and the big red arrow, because you've got a lot of selling and you've got a lot of buying matching it. So now we know this level's holding. We know we've got the chart in front of us. We can see where it's come from. And so now we're looking for some sort of clue. We've got a little iceberg there at 749. He's broken. We'll see if he comes back on. He's lifting his test liquidity. He's back on again. You notice that little bit of an algorithm. You get quite a lot of algorithms in the grains and the commodities markets. So we saw that level hold. Then we saw really not just holding, but sellers still aggressive. Now you have to make the decision then whether the sellers are, you think the sellers are going to lift, or you think they're done, they've come quite a long way, they've had their way for quite a while, or whether the buyers are going to overcome them, or whether it's just a pause and likely to push lower. But when you see that sort of accumulation, that sort of volume down there, then it's something you need to pay attention to.